See if this kicks on for me. I'll have to pause it in the background. All right, so this is the first of several episodes that we're going to have. This one's a live masterclass. We're going to carry these guys through the basics of becoming traders, and then we're going to have a bunch of one-on-one episodes with each person when we can, and kind of round out that mentorship. So we're going to see what we can get out of this. Man, saying I'm late. Hang on a second. I'm sorry, guys.
So you're not live on my end.
Yeah, this YouTube hates me.
It's not the only one.
You're right. Sorry, guys. Give me one moment here.
Oh,
Is it live now?
there we go. Oh my God, I see myself.
Okay. Is it trippy?
I don't like it.
All right, here we go. We got Kev Cave, we got Annie, we got Nikki, we got KB, Taylor Brown. As always, a pleasure meeting you in Florida, sir. Did I miss anybody else? I have trouble reading. And potential hour. All right. Is that you, I assume, Zach?
Yeah.
All right, cool. Fair enough. All right. So I just kind of want to introduce you guys first. So we'll start with Mr. Cicero here, Zach, and we'll get rocking and rolling. How you doing?
Oh, I have to talk.
Oh yeah, no pressure. Do it.
Doing great. What do you want me to say?
Just kind of, what do you, like, how'd you get exposed to the market? I guess we should structure that a little bit, yeah. What's your social security number?
All right, well, how did I get exposed to the market? I have no clue.
Oh, okay. You think maybe it was COVID exposure?
Yeah, I didn't get vaccinated, so COVID got me into the market.
All right, just climbed right into your bag. What kind of goals do you have? Like, what are you looking to get out of the market?
Goals, financial freedom, kind of just be able to support myself and my future.
Okay, that's good. That's probably one of the best motivators out there, right? You're tired of the 9 to 5, even though your job is pretty cool.
I can't complain.
You got a nice
Definitely
office.
Can't complain.
Pretty shiny out there. All right, well, we're gonna see what we can do to get you to that goal in an efficient manner, and we'll see what we can stumble across on the way to make the most of it. All right, and we also have Siphons in the Discord here with us. He's currently driving. He's a worker, so he's got to drive. So we'll come back to him if he's not able to talk. And that leaves us with Patrick.
How's it going?
Patrick, ugh, you're not a new trader. Get out of here.
No, but I'm trying to be a better trader.
Ooh, all right, that's fair. Yeah, would you buy a truck and a house off the market, and then you're like, nah, I'm done.
I found a lot of success that was kind of, if I was being honest, bad behavior that was being rewarded. So I want to try to reintroduce myself to the market the way that it should be.
Okay, fair enough. You're kind of yelling at us, by the way.
Oh, sorry.
It's okay, and you're motivated. I like it, but damn, I'm just kidding. No, that's good. I mean, like I said, you have the perfect trajectory, right? You got in the market, you learned enough to be dangerous, and you stopped before you actually hurt yourself. That's perfect. Yeah, you said your mic is super hot. It works out.
Is that better?
Oh yeah, much better. Thank you.
Okay.
You moved it outside of your trachea. That's a good start.
I regurgitated my mic.
Yeah, that's good. Yeah, so you kind of have a unique story. I think you and I both do, right? And we tend to copy each other a lot. But this is one specific spot where we kind of deviate. So it's good. I mean, I'm glad you're set up, but now you want to kind of take what you have, right, and stabilize it, right? So you're not throwing it all into SPX 0 days and racking in 700% profits, and it's a lot of stress,
Basically.
man.
Yeah. Well, and I honestly, I kind of almost took myself out of the market because the style that I was trading, it really worked for me at the time and the time that I could commit, but I no longer have that time. And now I want to find a more sustainable way to trade.
That's true. That's what it's all about, man. What we're doing in the market is we're buying time, right? That's a finite resource. It's valuable, way more valuable than money, but we kind of need money to buy it, right? So it's good. I'm super happy for you, and I know you got your own motivations and stuff. You got a wife and a kid, and probably a couple you don't know about, but but
only if you're hiding them.
Good to be prepared. Don't worry about it. All right, so all right. Now that the introductions are kind of out of the way, we got to wait for Siphons to get back and safe. I don't want him to focus on this while he's trying to drive.
That's okay,
Hilarious.
Pookies. I can at least talk. So,
Okay.
yeah, I am on my 9 to 5, as you guys already know, and I got my market exposure through at the time of COVID.
Yes.
I stumbled upon PB through Facebook, and I was a member, not a no, I was a free member for a while, following the free chats. And then I think I did become a premium member for a month or two.
Mhm.
And then the work got the best out of me, and I lost focus on the market, and it just swayed away from me for a while. And then I got back in couple months back, and I joined in as a lifetime member.
You just jump right
And
in.
yeah, just jump right in because I knew what is going on here, and I know this is what I want. Definitely not a 9 to 5, an alternate to 95 for sure. But at this point, I am forced to be in the 9 to 5.
Okay. Well, that's so we're gonna dig into the hierarchy of things a little bit later, but
Mm-hmm.
it's that I think is the kind of journey that I think a lot of traders take is they jump in, they find something that they see value in, but they can't quite lock it in. And then they,
Mm-hmm.
get a little bit uncomfortable, a little bit impatient, and then they just take big risks, probably hurt themselves.
Right.
And then they decide to just like take a different approach, right? And if you can do that a few times, that's
Mm-hmm.
great. But if you do it a bunch of times, you're gonna wash out. so,
Yep. Yep.
um, so that's good. I mean, that commitment to lifetime kind of implies that you see yourself here for a couple of years at least, so you can save some money on subscriptions at the very least, right?
Mm-hmm. Mm-hmm. I've already made my money, subscription money back.
Jeez. All right. Well, good for you, man.
Yep.
All right.
And again, without knowing anything, just following the alerts.
Okay, so you're here with us basically for free for for whatever. Well, that's good.
Yep.
That means that you're in the same kind of position as Patrick. Like that immediate need is
Yep.
met, and you can start fresh
Mm-hmm.
with a little more experience, a little more discipline,
Yep. Yep.
without that pressure of having that like subscription fee and trying to
Right.
convince the wife it's
Trying to force myself into getting stuff. Yep. Yep.
Yep.
Yep. I'm out of that.
beautiful. I'd love to hear that. So yeah, so I guess what are your kind of goals? Like, what do you want to do? You want to just get out of your 9 to 5 job and take care
Yeah,
of
that's my end goal. But along the way, I definitely want to learn the strategies out there. I keep hearing a lot of people talking about a lot of strategies.
Mhm.
So I definitely want to learn that. I do have realized my own pitfalls. And what do I lack from trading perspective?
Okay.
So definitely want to get better at those things as well.
Beautiful. All right, and yeah, like I said, we're gonna kind of dig into all this stuff, kind of in an order. It's gonna be a little bit freestyle here, but
Mm-hmm.
that's how we get the best conversations. So,
Right.
first off, I just want to start with some beginner foundational stuff, right? Like, what is the market? What are brokers and stuff like that? Because I feel like that's a lot of the misconceptions. They kind of they're rooted in kind of the wrong stuff, right? So, the market, like what it is and what it isn't, is very clear, right? It's not a casino for everybody. Like a lot of people just want to gamble and have fun, and that's awesome. I love it. I hope they make it big, but I get it. But other people kind of want to take it a little more seriously. So for those people that want to take it seriously, they're not going to have the same 50-50 chance of making $1 million in a month, right? So you might not. You probably won't if you're a gambler. But it is possible to grow wealth and treat it basically like a glorified savings account. That's kind of what we're going to lean into today. Um, Now, if you don't understand what brokers are and what like how companies participate and how you participate, you're probably just going to lean hard into technical analysis like most traders do, and you're going to try to find that strategy that works, and they're not going to work for you. You're going to wash yourself out of the market or blow something up, and then have a difficult conversation with your spouse, right? But we can avoid that by just taking a common sense approach to the market. So first off, the market itself is, and for those who are on like the audience here, the Rags to Riches team, you guys already know this stuff, but it's good to have that refresher, right? So the market is a series of exchanges, okay? And an exchange is just like an online auction house where you can participate. People can buy and sell pieces of company. They can sell gold. They can sell oil, whatever it is, right? Now that's commodities. We'll get into all that later, but that's one part of it, right? So when a company, well, I guess we should start with the companies, right? So when a company gets big enough, they can take pieces of their company and they can chop them up into little smaller pieces and they can offer them to the public. Okay, that's a good way for a company just to make money. Short term, then they can use that money to hire employees, research things, blow on corporate retreats, whatever they want to do, right? It's not our problem. But they have to do that through the exchange. Otherwise it won't be able to make it into our hands and there's no stock market, right? So when a company wants to offer these shares, they have to use what's called a broker. And a broker is just a licensed agent that helps make those transactions possible. So our trading brokers like Webull, Robinhood, Fidelity, E-Trade, all those are retail brokers. Like, we're not writing huge contracts and selling millions of dollars worth of shares to the market. We're just trading what we trade in our account, and then they kind of settle things behind the scenes. All right. On the other side of that, though, there's the institutional brokers, and I can't remember exactly what the term is, but they're the ones that just sell the shares of the companies to the actual exchange, and then they kind of handle those transactions on the institutional side. So they kind of sell to banks, they sell to the bigger firms, things like that. And basically that's how they make their money, is through those transactions. So they don't care if the stock goes up or down. They only want participation. And that's why you see things like settled cash in Webull. They offer you interest rates and stuff just for keeping money in their portfolio. It's a lot like a bank. If you deposit like $10,000 into a bank, $9,000 of that is going towards a loan for somebody so that they can make money on those interest payments. And they make money off your money, and it's just a big, ugly, nasty cycle, and we get caught in it if we try to gamble against that. So that's kind of why we're here today, is so we can start fresh and get a clean approach on the market so that we're not jumping into stuff face first and hoping we get it right? So in order to actually participate in the market, people like you and I have to have a brokerage account. All right. Now, these guys already have brokerage accounts, but if you don't, you can go to Webull, you can go to Robinhood. Those are two of the most popular kind of beginner-friendly ones. There's also Thinkorswim, which is a TD Ameritrade brokerage. There's TradingView, which is a platform that you can connect to brokerages. So there's all kinds of different opportunities out there that don't really cost money. And for you guys specifically, I kind of don't want you to trade. I can't legally tell you not to, but I don't want you to trade too much. Or if at all even, until we kind of get a plan in place, right? Because if you don't know stuff, why would you risk it, right? So that kind of brings me to my other point here, just for legal purposes, because I got to go through this spiel. I can't legally tell anybody what to do. I'm not licensed. I don't have a Series 65. I don't have a Series 7. I don't want them. They're stupid, and I hate them. They smell bad, but you guys can make your own decisions. You're going to be the ones pushing your own buttons. I'm just going to expose you guys to some education and insight, and that's the best way for you to succeed, because I don't know what's in your head. So it wouldn't be ethical for me to give you, I'm not talking about just legal-wise, but it wouldn't be ethical for me to try to tell you how to trade, because I don't know anything about your psyche and your traits and what's going to trigger you to hit that button, right? That's got to come from you. And this whole process is it's just a big system that's going to dig down into the guts of your brain, basically, and figure out what those are and bring them to the surface so we can put names on them, right? That's all we do. That's my whole job, is just teaching you guys how to figure stuff out about yourself and put specifics in place so you don't hurt yourself with those things. Snowflake, I'm gonna break your legs, man. I'm just kidding. All right, so do you guys have any questions so far about like just what the market is? I'll ramble about exchanges here in a little bit, but
no. I mean, you pretty much summed it up. Okay. when we're going over the different platforms to use, which one would you suggest for a beginner?
Well, that's a good question. So they all kind of have their pros and cons. And if you are in the PB server, if you go to PBAlerts.com, you can get in the server. It's free to join that part, and there's free education. There is a breakdown of the different brokerages, and their kind of their pros and cons. Like Robinhood, for example, used to only allow trading from like 9 a.m. to 6 p.m., for example, but now it's round the clock for them because they've got that internal resolution stuff. Webull is 4 a.m. to 8 p.m. Neither of those guys charge fees, but if you get on a broker like E-Trade, they might charge you commissions. If you're outside the U.S., you might have to pay commissions. If you trade options, you got to pay fees on those. So it's really worth just kind of picking one, digging into it, looking at reviews online. I'm not trying to plug like affiliate stuff in here. Like, you guys are never going to get a link from me for Webull because I'm not trying to make money off of you guys making money. But just look at, like, watch YouTube videos, for example, like this one. Just watch and see kind of how the interface works, try it out. None of these require any money just to try it, and as far as I'm aware anyway. If it does, you can just delete it, right? So that's a great question. I would definitely look at the fee schedule, though, because if you're someone that doesn't want to pay to trade like I do, we're pretty spoiled here in America, so I just use Webull. It's got just the right balance of powerful, complicated interface and still beginner friendly enough to not really destroy too much once you get kind of a lay of the land. I hate Robinhood. Personally.
In my experience too, I like Webull for the paper trading is really, really solid.
Absolutely. And that's kind of another point here is that if you guys aren't trading, you're not losing money, right? It's free to paper trade. It's free to literally just grab a piece of paper and a pen and just write down dates, times, prices, and tickers, and then just watch it, right? So a lot of people want to jump in. They want to have skin in the game. They want to, make their millions, and they want to spend their time and be compensated for it. Otherwise, it's a waste of time. But you don't have to do that, because what's going to happen in a lot of cases is you're going to do that and lose money. So not only have you wasted time, but you've paid for it. So it's not good to do that if you're not able to. So we can always paper trade. We can always just use good old-fashioned pen and paper if you want. So, all right, if there's no other questions for that, I kind of want to get into the exchange portion of it and kind of explain how actual buying and selling works. And then I'll kind of get into some portfolio management stuff and some actual strategy. Okay, so this is kind of a crash course. You guys are getting the brunt of it because you guys are here and you kind of already are exposed to it. So for the viewers, if you want to catch up, I got 80-something videos you can watch, and we'll do more of these one-on-one sessions. But let's get started. So there's different exchanges, right? There's the Russell, there's the S&P, there's the Nasdaq, the Dow. And they all kind of have different listing criteria, and ultimately all they are is different auction houses, basically. So if I want to trade a lower cost company that doesn't have, it's not an industrial stock and it doesn't have to have a certain market cap and stuff like that, it'll probably be on the S&P. And that's just the higher performing, lower cost tickers. Even though they could be several $100s, it's still lower cost in most cases. And those are, uplisted and delisted all the time. And we'll get to delists here in a minute. But regardless of what exchange you're on, there's Amex, there's OTC exchanges and things like that. You're only going to have access to the main ones in most cases if you're in America, because that's just where you get the cheap data. It's where you get the most participation. You can get to some pretty exotic exchanges if you want to, but you're probably not going to get to that point unless you've got like 8 or 9 figures. And at that point, you don't need to be listening to me. And it's not really worth it, in my opinion, to go too far out of the mainstream stuff. So if we take the S&P, for example, when a company like McDonald's, for example, wants to get their shares out there, they want to go out and make money off the market, they divvy up a portion of their company, their net worth, right? And they break it up and they put it on little pieces of paper. And then they offer it to an exchange through a broker. The broker takes their commission, and they just put them on the exchange, basically. And then people like you and I can buy those shares, and that process is known as bidding and asking. Let me rewind. When the shares are given to the exchange, they go into a pool, and that pool is known as the float. And that's just a big number that's usually millions or billions, and that just kind of tells you how many little pieces of paper, how many pieces of that company are out there. And each one has a certain value based on how many are in the pool and how many kind of dollars they're all worth cumulative. Does that make sense? All right, so that total value, if you add them all up, that's the market cap. So that's just a big number that represents kind of how much the company's worth to the market. All right, so like Tesla's got a huge market cap. It's a big company, a lot of dollars per share, and they're not heavily diluted, so it's a big number. Okay. You get like a little mom and pop that just uplisted, they're probably going to be a much smaller market cap because there's fewer shares, but they're also much cheaper in most cases because they're not going to get much money. Okay. So that kind of brings us to dilution, which I hope you guys are taking notes in these words here because it's going to be a lot. So when a stock has a lot of shares, okay, and it doesn't just have to be a stock, but let's just use stocks for simplicity. So when they have a lot of shares out there, a lot of those little pieces of paper, that is like having a lot of dollars in the economy, right? Each one kind of counts for less. It's going to take more to buy something or to make something happen. And that is heavily diluted in that case because the dollars just become heavy, right? Whereas if there's only a few, right, you can think of that as more of like a limited editions sort of thing, where the fewer shares increase value. You don't need as many to make stuff happen because there's fewer of them, they're more rare, okay? And when we go to buy and sell these things, we have to obey what's known as the bid and the ask. And that's basically just a way to actually fill out the orders, right? So if I want to buy shares, I have to put in a number to the market that says I'm willing to buy shares at this value or better. Okay, and we'll get into the order types and all that good stuff. And when I want to sell shares, I have to do the same thing. So when I'm trying to buy shares, I want to put in a number. Let's say a stock is $5 per share. I have to pay at least $5 per share in order to buy that share. Okay, and it has to be a number of shares and a price, and it's got to be a certain order type, and it has to have a matching order on the other side. So what we see a lot of times is, like, if you look at my chart right here, let me just pull this up. If you see right here, for example, if you don't know what the colors are, right, these bars and these bars down here, this down here just represents the volume. So when the bars here are bigger, that's just higher volume. That just means there's a lot more participation. And a lot of people view this as buying and selling separately. Like, they'll see in this case, the white ones are the bulls, or the buyers, and the red ones are the sellers. They'll see this as people just selling shares, and that's really not what's happening. This is a combined effort between buyers and sellers. Every single one of these bars is, because every single order that needs to be filled has to have a match. Does that make sense? And that's one of the fundamental misunderstandings people have when it comes to buying and selling shares, and specifically about reading volume. And we'll get into the analysis part after, but it really just boils down to not understanding how the actual transactions take place, and that's where people kind of get messed up when they look at volume and price action and stuff like that. So, like, this big red bar, this is not just sellers. This is orders getting filled on the bid side, cheaper and cheaper prices, until the price kind of deflates and pulls down. There's still buyers all along this bar, and there's sellers all along this bar. Otherwise, the price wouldn't move at all because there wouldn't be any orders. So you're not buying and selling directly through, like, to that broker, unless you're trading Robinhood and all that good garbage. We'll get into that later, but you're matching orders equal and opposite to your own order. So if I want to buy shares at $5 and I want to buy 10 of them, someone else has to be selling 10 shares for $5. And then they get matched by the exchange. That's all automatic. And the broker gets their little tiny micro fee. Everybody's happy. I get my shares. They get money. And then I sell my shares when it drops down to $3 and I lose my money. Does that make sense?
Sounds about right.
Yeah, we've all been there, right? So what can we do with that information, right? We can look at price action, which, again, don't worry about this. I'm going to change all this. I'm actually just going to start fresh, and we're just going to pretend I'm a brand new trader. I don't know why I just turned that back on.
Because you're brand new.
Probably, yeah, that's what it is. All right, so I'm going to erase the drawings. We're just going to start fresh, and I'll even go in here and change my theme back to the old red and green, if I can. I don't remember where I changed that. All right, we'll come back to it. Anyway, white is green now. Remember that. It's an accessibility setting. I forgot exactly where it is, and I don't want to waste time looking for it. So when most people are exposed to the market, specifically technical analysis, this is probably what they're going to see. So the older folks like me, we probably... Oh, that got ugly. We probably remember seeing these in the newspaper, right? And on the news channels and all that good stuff. It was just a line chart. It was ugly. It's just something old people did, right? Like, we didn't know too much about it, other than it was just a scribbly line, and people made money or they lost their life savings, right? So what this actually represents, and I don't want to go too far in the technical analysis hole until we get a trading plan set up, but what this represents is it's price, right? This is the y-axis here. It's just price. As price goes up, the plots go higher, and this is time. So this is the daily chart, which we'll get into intervals in a little bit. But this is as time goes by, the price goes up and down. So this is just a graphical representation of price over time. And specifically with a line chart, which is the most common line chart for new traders, it just represents one plot per day in this case at one specific price. So there's only two values here which point to one plot. And that one plot is just the closing price for that day. So at 4 o'clock, when the market closes, that's where the price was. So on this day, it was, if you look right up here, this is the OHLC, which I'll explain on future episodes. We're just looking at the C, that stands for close. So it's open, high, low, and close. So we're just going to look at the C value. So on this day right here, the close was $239.20. This day was $251.51. So for that day, the price went up $12.31. And then the next day it went down $5.13 to $246.38, blah, 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 right? So it's pretty easy to identify and just kind of eyeball, like, you know, what's the price generally doing? If we just zoom out really far, right? This is what people don't do. They don't really zoom out very far. If we just look at this because it's a little bit cleaner, right? I'm not cherry picking info here. We can see that this generally looks like it's trending upward, right? The lows and the lines and stuff, it's just occupying more and more space up here at the top as price goes on. So this can be considered an uptrend, okay? Over here, it's kind of coming down, right? You still got these big swings in the way, but overall, it's kind of coming down. You got lower highs, lower lows. It's just not able to push higher, right? And then you get kind of this guy down here, and then the price does break up, and then it just keeps going back down. So it's a downtrend with an interruption, right? And this is kind of where people get lost, is they look way too close. They're down here on like the 1 minute time frame, you know, trying to guess every single move, and they don't look at the higher time frames. And the time frame itself just kind of represents some amount of data, all right? And if we go all the way to the current time, like now, right? We're not seeing what's happening at, what is this, 6:27 at night Eastern. All we're seeing here is the closing price at 4 o'clock, okay? And then we see the closing price here yesterday at 4 o'clock and here at 4 o'clock. We don't see how high or low this went throughout the day. We don't see anything that's happening after hours. We don't see any of that other stuff because we only see the closing price for the entire day and the amount of volume, which is 73.85 million for the day. Not a lot we can do with that unless we're focused exclusively on riding those big overall trends and not caring about the noise, right? But that's not why we're here. So what we can look at instead is we can look at a different candle type. So in Webull, for example, if you guys are on different brokers, you have to do it differently. But if you're on Webull, you have to click this line style button. And there's a couple different options here, but we're just going to look at candles today. And that's kind of just to keep things simple. We can dive into other stuff, but ultimately these two concepts are the same. So for a candle, right, what we see in this case is we've got a body, which is just this big block. Then we've got a wick or a line that sticks out of the top, and a wick or shadow if you're one of those people. It sticks out of the bottom. So you got the little lines that come up and down. Stupid crosshairs on, so I gotta disable that real quick. No, that's a sync setting, my bad. So basically what this tells us is that we've got 4 points of data, okay? So in this case, we've got a line right here. I'm drawing the horizontal line here, but I'm going to keep my mouse over here, but I'm looking at this red candle. So you guys see where that wick goes up and stops, and then it comes back down to the body? That is the highest price point of that period, which in this case is today, okay? And then this one down here, the bottom wick, is the lowest price point of the day, which, again, you guys already know this stuff, but I'm just kind of recapping it for the other traders here. But this is the total range of the price action for the entire day, minus, extended hours, like pre-market and all that good stuff. So from 9:30 a.m. Eastern, when the bell rings, the market opens, all the crazy stuff happens, until 4 o'clock Eastern, when it closes, this is as high and as low as the price went, okay? The price opened right here at the top of this body, okay? And that's at 9:30 a.m. And it closed here at 4 p.m. And the reason I know that this is the open and this is the close is because the candle's red, which means that it went down overall from where it opened. And in this case, it went up from where it opened. So this would be the open, this would be the close, the high would be here, and the low would be here, which you guys can't see the wick because the stupid crosshair's in the way. Does that kind of make sense as far as understanding what this data shows us?
Sure.
Okay. So if we were looking just at a line chart, we would only see this value right here. Just this closing price. Okay, so let me just put those back really quick. And now we have 4 points of data that we can use, which is pretty good, right? It's a little bit better. We get a little more insight into what happened, because what can happen a lot of times is if you just see the closing price, which is this guy, right? I'll just make that yellow. right? You don't know anything about this entire range right here, okay? You don't know how high the price went. You don't know how low it went. You just know that it closed here. You don't even know where it opened, really, other than the previous candle. So that's a little bit more data that we can use, a little more information to kind of give us some
Because I
insight.
had a quick question for you.
Yeah, what's up?
So where it's the highest price, like so your top wick off of that red candle, is that the highest that ticker moved, or the highest that a share was purchased for?
Oh, good question. It's purchased and sold for the
Ooh.
same price. So that is a reflection of the mid price. So if you look right here, this right here is the bid and ask spread. This specific component is the order book, which we'll get into much later. But this is kind of the minimum price and the max price that shares can sell for immediately in the moment. Does that make sense? Like,
Yeah.
that's how much people are currently buying and selling and getting their orders filled at.
The
So
market
it's-
price.
Yep. Now, granted, we're in extended hours, so it's going to be different now, but that's generally the idea when the market's open. And this thing will fly all day long on Tesla. Now, when it comes to this price point up here, if you want to test this, you can just look through the entire time in sales for the whole day if you want. I don't recommend it. It's not good for your mental health, but you could. At some point, yes, some order was filled at this price or above it because it was filled on the ask side. And this price that you're seeing, so the open, high, low, and close, actually any price at any time that you're seeing on a chart, isn't necessarily a direct representation of the order price that was filled, but more so where that fill moved the mid price. And the mid price is just between the bid and the ask. That's kind of the average share price at the current value. So the 228.22, it may have gotten filled at that price, or it might have gotten filled like 1 cent above it, but it was enough to drag the mid price up to 228.22. And that's not really important as far as like the exceptions to that rule, unless you get into like low float garbage.
Sure.
Because then, yeah, I mean, your fills are going to be all over the place, and that mid price becomes kind of critical. But yeah, that's kind of the idea, though. Is this the highest that people were willing to pay for shares, and the highest they were willing to sell them for at the moment? And price just kind of fell back down a little bit later in the day. So if we look at this on like the 15-minute chart, and let me just turn off extended hours as well. We can kind of visualize it, right? So if we look at this chart right here is the first one of the day, and this one right here is the last one of the day. Okay, these vertical lines. So this whole range right here was the entire price range for the stock all day long. Okay, so the price kind of stayed within that envelope. So this morning, market opened, price shot up really, really high, and then it came back and it closed right here, higher than when it opened. Then the next candle opened here, moved up, moved down, and then kind of pulled back up a little bit. But it closed lower than it started, so it's a bearish candle. Bearish just means that sellers kind of push the price down a little bit farther than where it opened. And then the next candle, we get a huge bearish candle. And then we get a small one with a lot of contention. So the price kind of was really violent here, but it really didn't close much farther from where it opened. And then we had another massive red candle followed by a whole bunch of, crazy price action and all that good stuff. It closed lower for the day than where it opened, right? So bearish day. So I don't want to get too far into the actual technical analysis stuff, but the main point that I'm trying to make here is that this stuff tells a story. And it's a story we're not going to be able to see if we're just looking at a line where each plot is just a closing price. Does that make sense?
Yeah, absolutely.
All right. And if you just want to use the line chart, you absolutely can, but just understand that you're going to be missing pieces of data, so certain strategies aren't going to work for you very well. Sorry, I got to move around in my loud chair. All right. So, and again, that's just the main point, right? We could see where the price opened, how high it went, how low it went, where it closed, and where that is in relation to the opening price. And that'll kind of give us some insight into, what the price should be doing or what it wants to do in a lot of cases. And we can also compare it to the volume. So if we look at the magnitude of these volume bars, the height of these at the bottom here, we can see, this right here, we get tiny, tiny little candle bodies. That's what these are, just the little bodies here with the wicks. And we also have really low volume. So this tells me it's indecision. That means that people aren't down here fighting to move the price up and down. They're just kind of letting it hang out down here. They're waiting to see where it goes. Whereas, over here, you get strong directional movements, and it's clearly bearish at this point. Like, price just wants to push down. The volume is much stronger here. It's much higher. And then you get some bullish move right here, but even this one's kind of weak, right? It's a smaller volume candle. That means that, you know, less participation happened, and it's more contention. So they weren't really able to push the price up very high. Then you got these small red bodies with these big wicks to the upside, which means that they tried to push the price up and it got slapped down, and it tried to push the price up and it got slapped down. So they tried it twice, and then a third time it took, and then it just still sold back off. So this was not a day to trade bullish stuff after this massive sell-off started, right? But you don't have to know all that. Like, that's not the that's kind of like the advanced level stuff. Like, you don't really need to know anything about these charts really to be a successful trader, because we're going to take the opposite approach, and we're not going to focus 90% of our effort on technical analysis. We just have to understand kind of what it represents. And instead, we're going to focus on building a portfolio with some common sense rules, and we're going to be responsible with our money so that we don't lose it, right? Because what's going to happen is people are going to watch that part of this episode, and they're going to go down to the 1 minute, and they'll be like, oh, I knew this was going to happen, right? So they're going to jump bullish into Tesla tomorrow, right? They're going to see a strong bullish move here. They're going to see a red massive sell-off, say, oh, it's due for a comeback. It's going to bounce off this low. All that good stuff we already know because we've all done it, right? So instead of doing all that stuff, what we can do is we can look at how we manage an actual portfolio. So I'm going to open up Miro here, which is just it's a flowchart program, and I'm going to go ahead and screen share that. So I gotta do one of these guys, and I'm just going to kick it back over to here, and then I have to find it. Okay, here we go. So when it comes to managing a portfolio, there's a whole bunch of different strategies we can use. And then, again, I'm sorry if you guys have already been through this, but we're going to do it again. Yeah, it's Snowflake. It has to bounce. All right. So one of the best ways that we can manage risk, and that is our job, right? As Patrick knows, we all suck at guessing. And successful traders are not people that are good guessers. They're not consistently good guesses. It's the fact that they can work a system mechanically and consistently, and that system emphasizes risk management and minimizing losses. It's not at all about how big your profits are. Everyone's going to get big profits, everyone's going to get small profits, but if your losses are all the same size or smaller, you're going to be successful at some point, right? This is always one of the more difficult questions to ask, but it's worth asking everybody who's watching this to ask yourself. If you took all your big red trades, specifically SPY, and you took that big ugly red number and you added it to your portfolio value, anything that was over a certain size, where would you be at today? Right? It's painful. It sucks for a lot of people. Very few people can answer that question without like feeling bad, right? And that's because we tie our emotions to money and all that good stuff. So the best way to reframe that is to understand that we can't undo what's been done. Like it's not coming back. Not like that. You can get it back at tax time when you use it as a deduction, but you're not going to get that cash back in your portfolio for a little bit. And the other part of that is to take value out of that and understand that you can avoid those big losses just by not doing that same stuff again, right? And that's kind of why we're here. Except Patrick, because he's got it figured out.
Not at all.
So if we look at a portfolio, one of the easiest ways that we can clearly identify as the best path to not losing 90% of your portfolio is don't put 90% into one trade, right? That's just straight up old school diversification advice. Don't put all your eggs in one basket, right? But what do? We want to make money. We want to do it fast. We got a small account. We're like, oh, I have to make this count. This contract's a little expensive, so I'm going to buy it. It's 80% of your portfolio and it's 40% down. What do you do, right? Like, oh, I got 20% left. I can add some more, right? You're already so far out of whack with your allocation, and you're just an emotional mess, and you're not making rational decisions at that point. You're going to put 90% of the portfolio in, and it's going to be down 60%, and then that 10% you have left isn't going to be enough to be meaningful. The price will blast, in at the end of the day, and it's still not enough to make that come back to break even. You've lost, right? You lost as soon as you over allocated. You didn't lose at the end of the day. So if you want to do that, buy yourself a contract or document a contract at some point throughout the day and just track it. And 2 hours later, if it's a short expiration contract like a 0 day, and this doesn't apply to brand new people, obviously, because you guys don't really know what contracts are yet. But for you guys, if you really want to understand the math, see where that's at later on in the day. If you bought it at $3 and it's down to $1.50, it has to double just for you to get back to break even. But look at how much price action has to happen to get that contract to double. Most of the time, it's not going to happen. It's not realistic. Like a $10 stock might have to go $26 up, So it's just working against you. And it's unnecessary. Once you figure out, you don't have to do that. So ignore all this stuff down here for right now. This is just a very, very bare bones kind of approach to how we can manage a portfolio. What's up? Yoda is talking to me. Where is Yoda talking to me? Is it in Discord? Somebody want to help me out with that?
Don't see anyone on the new
Yeah, hop on YouTube, buddy.
channel.
Yeah. Okay. Yeah, if somebody can kind of paraphrase for me, that'd be awesome. I don't want to get too distracted because I am drinking a Monster, and that's going to end very poorly. All right. So if I have $1,000 in a portfolio, which you can see conveniently that I do, right? Can you guys see my? Can you guys? Well, you guys remember my Webull, right? I got too many windows open. You guys should
We are
see
seeing the same total portfolio screen.
this guy, right?
Yeah.
Okay.
Yep.
All right. So I specifically for this, right? I have another Webull account. I reduced it down to $1,000. Haven't traded on it for a little bit just to make sure that it stays at 1,000. I think it's like 1,022 or something. Because I'm going to be walking through this with you guys just like I did when I started this project back in last September. So for this, I keep changing my windows here. So if I have $1,000 and I don't want to lose half of it, what do I do? Right? I don't put half of it into one position. Okay? And that's just the best way. And then what we can actually do is we can break it up into like multiple blocks or allocations. I'm just going to refer to these as blocks because it's easier and they're actual blocks on this. If I don't want to risk any more than 10% of my money on anything, I don't have to. I can just use 10% blocks. And then I can group these, right? Like if I want to do 7 swing trades, which is where you're trading across multiple days or multiple weeks, sometimes even months for each position, I can have up to 7 of those at any given time if I want to. I can have 3 of these dedicated just to day trades, which is where you're buying and selling within the same day. I can have, 1 of these dedicated to options. I can have 3 of them dedicated to bonds or commodities or, any other strategy or combination that I want, but I have to understand where that money is going. And before we even get to that point, we need to make sure that this is going to be valuable to us. We need to make sure it's a worthwhile investment. And this is where I think a lot of traders kind of, again, they just derail themselves and set themselves up to fail before they even get started. If you're not financially stable outside the stock market, you're not going to be stable in the stock market. That's a golden rule. You're going to mess yourself up. You're going to have extra pressure. You're going to take extra risks. You're going to feel bad. You're going to feel feelings, and you're going to hurt yourself. The best way you can avoid that is just be financially stable outside the market to the best of your ability. It doesn't mean you have to live on ramen just to feed the market. You don't have to work 3 jobs just to be able to trade. It just means kind of try your best, right? And you can always reach out for help and crowdsource the information that you need to try to get yourself into a better financial position. But like Snowflake, literally put aside $10 a week, okay? And just that racked up, it adds up over time. It's a savings account at most, okay? And if you can't make more than 1% to 2% a year in the market with practice, and you can't project that number out where it's going to make sense and be like, okay, this is something I should put my money into, why not put that money into a savings account at a bank? Because that's going to get you that 1% to 2%, at least, and it's consistent, right? If you can beat that 1% to 2%, but maybe you can't beat 5%, okay? Or if you have a broker that can automatically get you 5% like Webull and you just have settled cash sitting in there, that's going to outperform that savings account. So why not put the money in there instead? It just makes sense, right? And that's, again, this is where I kind of start giving options to you people and saying, I don't make your decisions for you. I want you to do that for yourself, but I will ask you some questions that hopefully you can answer pretty easily and kind of encourage you to do things that make sense. I'm trying to find the, okay, here. So I actually have it written out, so I'll just read it for you guys so I don't have to screen share. If a bank account gets you 1% to 2% a year, okay? Certain brokers give you 5% interest just on settled cash. So it's literally just like a savings account, but you get 2.5 times that interest rate. So that makes sense to me. if you can't beat 6 to 8%, for example, why not consider a 401k or some other managed fund that you can review and make sure it's stable and stuff. I mean, don't put everything into a 401k if you don't want to risk everything, but it's a better option than a savings account that gets you 1 to 2% or a broker that gives you 5%. Now, there are some catches, and this is why it's important to just take one step at a time. With a savings account, for example, that 1 to 2% is easy. It's awesome. You don't have to do anything, but that's probably not going to outperform inflation, right? The kids that are born today are already set up to fail if they don't do stuff like this, right? You got to have multiple streams of revenue. You got to compound reinvest, all that good stuff just to keep up. If you want to do the 5% route on, let's say, Robinhood, for example, you have to pay a subscription fee, okay? That is going to require you to have a minimum number of dollars in there for that 5% to offset the cost of the subscription. That's $1,200, right? So if you don't have $1,200, maybe you don't use Robinhood for that, and maybe you switch to a different broker that doesn't have a fee like that, or a lower fee, or some other option. And if you can't do that, it can just stay in the savings account, right? There's a hierarchy here. Once you get over $1,200, then yeah, you can throw it in Robinhood and start making a net profit. Otherwise, you're just feeding Robinhood for no reason, right? And then, same with a 401k. Like maybe the management fees don't quite make sense for what you're putting into it, right? Maybe it makes more sense to keep that in a broker, or maybe it makes more sense to keep it in a savings account. So just kind of working your way up that ladder, one rung at a time. That's what's going to be important for you guys, and we're all going to start at different spots. So don't feel like there's any one answer here. But when you can beat a 401k, or when you know enough on like the dividend passive income realm, you can yield about 12 to 20% per year pretty easily without a lot of effort. So it's also a time factor. How much time are you willing to commit to this? If you don't want to research a bunch of stocks and learn about dividends and all that, you can leave it in your broker, or you can leave it in a savings account, right? You just fall back down that ladder without hurting yourself by just having some stability to build on, right? So if you are able to commit to dividends and research your growth stocks and have passive income and stuff like that, maybe you can beat 20% doing speculation, right? So you put a smaller and smaller amount in each area that's higher and higher on this hierarchy, and it just balances out super, super nicely. So for example, if I wanted all my life savings, right? If I wanted to put 70% of that in savings account that yields me 1 to maybe 3%, right? That's essentially what my big portfolio is. It's a 1 to 3%, super stable, but it's enough, right? And then, maybe I want to take 30% of that and put it in a broker that offers me, 5% interest. Okay. And these are bigger numbers, so it makes sense to keep the bulk of it kind of, the base of your pyramid should be the widest and the most stable, right? Then I want to take 70% of that money and put it into dividends or a 401k, right? And then I want to take 30% of that and put it into speculation. And that's kind of where we're leading to on this flow chart right here. You don't just have to break it up into equal positions and just speculate. And this is where people get messed up because, as a beginner strategy, yes, we teach this. We say, okay, you can break up your portfolio into 10 blocks of 10%. And then you can even break that up further into 3 buys per position, right? And all that does is just forces you to slow the hell down, right? You don't have to do any of this. But what we can do is we can recognize the value of having our stuff broken up. So if we're ready to invest in the market, okay, at this point we've got a savings account ideally, or some variant of it. We've got some sort of financial stability. We're going to get a steady paycheck, right? We want to have that stability first and then go into the market. Big or small, it doesn't matter. And if, for example, I am making consistent contributions, which I will be on this portfolio, if I start at $1,000, okay, and I add, let's say I add consistently to it every month. In this case, I'm going to add like $500. I'll just do that again, right? I'll just build this account up. If I have $1,000 and I want to use 70% for investments, aka dividend stocks and passive income, or passive options, sorry, I'm going to take $700 of that $1,000 and I'm going to put it into equal position sizes to keep it simple. You can also diversify by yield and stuff. We'll get into all that much later, but the idea here is that we're taking the bulk of our money and we're putting into the safer stuff, and we're taking a smaller portion of it. In this case, it's 30%, and we're putting that into the riskier stuff, right? Now this is a little bit outdated because we don't have to wait that, we don't have to wait for settled cash and stuff. It's an overnight settlement. But the idea here is still to limit the amount that we put into each type of trade. Okay? So for the investment side of it, if I'm taking 70% of everything I have in here and I'm putting it just into stable dividend stocks, that's going to pay me money, right? There's monthly payments, there's quarterly payments, and those are just a way for companies to reward shareholders, which we'll get into the dividend stuff much, much later, probably on the one-on-one episodes, but unless I have time tonight. But the idea here is that we're going to buy stocks, and those stocks are going to pay us. So we're sending money out into the market. It's going to go out and make friends, right? That's all we care about. That's the easiest way to trade and invest. And obviously, there's a lot of garbage out there, so we're gonna learn what to look for and all that good stuff. But the concept is just you're taking a portion of that share, you're converting it to cash, you're getting a tax advantage, all this good stuff we're going to learn about, and you're getting some cash back. And then you're going to be able to take that cash and reinvest it. Right? And that's kind of where we get into this reinvestment. And then that's going to contribute, that's going to count towards this portfolio value, and it's going to increase it on its own as long as the share price doesn't sell off too far. We're just going to keep getting those cash payouts, and we're just going to keep using those to buy more stocks. Okay? And then with the smaller amount, the speculation portion, that's just the day trades, swing trades, options, whatever we want to do, right? And we're going to use that however we decide to break it up based on our circumstances. And we're going to, trade with defined results. Okay, every single trade should have a defined reward and a defined risk. And the cool part here is that all of our profits from this can go right back into the reinvestment portion, which can end up in dividend stocks or whatever our passive income avenue is. So we can speculate all day long. And if we trim those profits and put them into the reinvestment portion, into dividends and stuff, that dollar amount that we're using will stay in a nice familiar range. And that will help us tremendously when it comes time to make decisions and have those habits in place and not mess ourselves up with the psychology stuff because, the number's growing too big too fast and we don't know what the hell we're doing. And, it gets scary, trust me. So it's a good problem to have, but it's also a really bad problem to have. So if we can keep everything in our most emotionally impacted area, right, where we have the most risk, if we can keep that exposure as small as possible and put the more stable stuff exposed to the larger amount of money, common sense dictates that we should have a growing portfolio over time. Does that make sense? But that's not what people do. They jump right into SPY 0 days. It's paycheck after paycheck. They're putting money in. We're going to be taking money out eventually, right? It might take forever, but getting started. But that's where the contributions come in, and that's where we optimize that speculation stuff. If you can take 30% of your money and speculate successfully, and by that I just mean not dying, you can very easily match the dividend payouts and essentially double what this number is pretty easily, right? Because dividends don't pay a whole lot, but the growth of the stock does, and the reinvested portion does, because if you have enough shares, they add up, you get more payouts, you use those payouts to buy more shares. It just compounds really nicely. The numbers get really stupid. And Einstein said, compound growth is the eighth wonder of the world. And it is. I love it. That's how I got to be where I'm at. But, Snowflake, I'm not attacking you. You're okay. Snowflake's figured it out, by the way. I love that guy. But this is the idea. So ignore the specifics of what's in all these boxes and just kind of take this decision logic and really try to internalize it, because if I'm outside the market, right, if I'm collecting a regular paycheck and I'm able to set aside $5-10 a week, right, think of it like an allowance that you're paying yourself. Okay, if you're able to just set that aside, put it into a glorified savings account, okay, you don't have to do anything at that point, right? You could just keep racking up that interest or saving, build the account up until it's $1,200. Then you can apply for that subscription and get the net growth there, right? Otherwise, just throw it in a savings account. No harm, no foul. If you want to. Then, if you want to try to increase that even further, right, you're still going to be making those consistent contributions, but you're not taking money out of the portfolio at this point. You're just adding more into it, and it's just growing and growing and growing anyway, like a savings account would, okay? It's just a good financial habit to be in. It doesn't really require any skills, right? You're just taking money that you're making from working and you're setting it aside somewhere where it's going to make a little bit more money, okay? Then if you want to get into, splitting those future contributions up, you're still going to have the base amount, but you're going to be able to take, 70-30 split or whatever your specific ratio is, right? Some people like 80% 20%, 90% 10%. It really just depends on what your preferences are. But the reason we want this first decision here, this first major decision, is if we lose this entire amount, the speculation amount, like let's say we just throw it all in a SPY 0-day trade and we just YOLO it and it goes against us, we're still going to grow that portfolio. And that's just something 90% of people can't figure out how to do. And we're just doing it by not throwing it all in, right? Now, you might still struggle on the investment side, the dividend stuff, it's not super easy, but it's not super complicated. But the idea here is that there's some very, very stable, very, very low-hanging fruit stocks out there that they just win, right? You don't need them to go up and triple in value and all that. You're really just about those consistent dividends. And what we're going to do here is we're going to leverage specifically the reinvestment and the tax advantage portions of these. And we're going to understand exactly how these dividend stocks kind of fuel the machine that grows and grows and grows and grows. And then this down here becomes completely irrelevant if you want it to. If you don't want to put work into the market, if you don't want to be a slave to the market, you don't have to be. This, again, is just another opportunity for us to buy free time. But it's absolutely not necessary. Does that make sense? Is that going to be easy for you to accept, Patrick, knowing that you paid off a house and a truck and all that using just speculation?
I don't like it.
Okay, all right. Well, you got some habits, and they're good. They're good habits. But there's a cleaner way, man. Do you feel like you were stressed out all the time, or that you had to like focus a lot?
100%. Yeah. No, I mean that was the whole thing, right? Like you remember the days I was.
Oh, I do.
all night long reading and charting and just stressing myself out, and it was a war of attrition for me. I mean, it was a nightmare, to be honest with you. I mean, I did well, but at what cost? It was stressful. It honestly, it kept me up at night.
Yeah. Well, look at you now. You're still up at night, but you control that, right? You're on your own terms. You're playing games and stuff, driving your scooters around.
That's right.
But that's a double-edged sword, right? Because it worked for you, right? You were able to buy that extra time. You were able to pay off stuff. You were able to really, really grow an account really fast. But it came at a cost, right? It was a mental cost and an emotional cost, and it sucked. But so there is a risk reward there, and a lot of people just do speculation, and sometimes you can figure it out. But the problem with this is it's not scalable, right? Because even if you become a master trader and you figured it all out, and you've got a $600,000 portfolio, and you're throwing them all into the same contract, and you just keep winning, you're going to run into a problem that you can't control, and that's liquidity. So once you get to a big enough size, you literally just can't get your orders filled because there's no matching orders, right? Your broker will try to chunk them up as best they can. You get partial fills, you get late fills, but you can't rely solely on speculation because you're never going to get filled. And that's why you see things like liquidity sweeps in the market, and like these order walls on the order book from institutions that have massive amounts of money, and they need to steal your shares basically. So they push it down below a stop loss, and you stop out, you sell them your shares, and then they release the price to the upside, and you kick yourself in the butt because you should have seen it coming, and you should have held your shares and all that. When in reality, it's just them trying to participate because they can't get filled unless it's in certain areas. But we can identify that when it's time to do the technical analysis stuff. We can find exactly where they're looking in most cases, and we can look to get filled in the same spot and just kind of ride along with them, rather than being the ones that are like, oh, I'm going to buy and hope, and it's 30, 40, 50% down. I'm like, it'll bounce back, right? And they push it down just past your breaking point, and you're like, sucks, I sell, right? And then it blasts, right? And that conditions you to do it again and again and again and again, and it's really, really bad, right? So to take a lot of that pressure off and the requirement to succeed when it comes to speculating, we got this stuff. Right, we got plenty of other ways to make money in the market. Granted, it's not flashy, it's not super shiny, but it's consistent and it's stable. Okay, so does this decision?
Boring.
It's boring as hell, dude.
One of the things you taught me a year and a half ago, 2 years, 3 years, however long it's been. Boring trading's better trading.
Yeah. Dude, I haven't said anything new in 3.5 years. If you look at my old posts, they're all the same. It's like, less is more. Focus on risk management. Focus on making your losses small. Wait till the trend's going in your direction. Like, it's all the same common sense rules. But hearing it 500 times might be annoying, but when you hear it 501 times and it happens to click, that'll change your life. It's awesome. That's why I like Snowflake and Matster and Mule and Bebnet and Onrod and all, and you and Cicero as well. Like, you guys are in position now where things are starting to actually sink in, and it's I don't know. You just got to hear a certain way, I guess. It's interesting. I'm the same way. I can hear stuff a million times, but I got to be able to listen to it, you know? But that's all it takes, is that one time. That's why I don't mind saying it 3.5 years, you know? But yeah, does this decision tree kind of make sense so far? Is there anything about this that you can think would make somebody go bankrupt or make somebody struggle in the market? Does it make sense? Doesn't have to be specifically dividends or specifically day trades, but does it make sense to put the bulk of your money into something that's a little bit more stable, a little bit more boring?
I like it.
Absolutely. I mean, if it does anything, it takes away the temptation to jump into something a little bit more flashy, and that's what it is. I mean, it's people seeing other people getting, making money on a quick speculation. People always share their profits, but they almost never share their losses. So they don't share the small wins either. So I mean, something like this is sustainable long term. It's just not sexy.
Absolutely. And in a perfect world, right? And this is where I want to get each of you three. All your losses should be the same size or smaller. All right. At that point, you're not showing your losses necessarily, or you're not celebrating them, I should say, because it's just not worth it, because they're insignificant at that point, right? But that's not what most traders do. Their losses are usually the same size as their wins, or they're much bigger, or they lose 50% and then they gain 50% and they're down 25%, right? You can't do that and expect to survive without throwing paycheck after paycheck into the market. So we're going to fix that, right? And the first step is taking most of the money and putting it into safe stuff, so that way that 30% or whatever, it doesn't destroy you if you mess it up horribly. Because I've done that. I've done it on purpose in front of these guys. I'll just buy some stupid stuff and just watch it go to zero. It's cool. It's fun. But I also know that I get that money back at tax time, up to a limit, right, with indefinite carry forward and all that good stuff that we'll dig into all later on. But that's not what destroys a trader. It's when it's the bulk of your money, and you just can't break that cycle, and you just, I'll throw more money at it, or I'll add more money and then I'll average down, right? When you put more money into the stock market with the intent of averaging down a position that you're holding, and you didn't intend to when you bought that position, that is your wallet crying for help at that point, because you're no longer trading to make money. You're trading to break even and get out from underneath that emotional pressure, right? You got to soothe that ego. And that's, that there's nothing wrong with that necessarily, because we're all human. And I think that's the psychology is really, really, really what helps put this stuff into context. And I think maybe what helps people hear things more effectively. Being a human means wanting to be right. Right? Our ancestors kind of needed to be right. They needed to be rewarded for being right, and they needed to be punished for being wrong. Otherwise, they didn't eat. Right? It wasn't good. Right? Our modern brains haven't really changed that much. We just don't appreciate the green and red candles, right? The shapes on the screen, they don't really appeal to the brain the same way. So it kind of impacts our ability to make decisions. So in this case, we kind of have to figure out how to override a lot of that stuff without stressing ourselves out, because the market is set up to exploit that, right? The institutions, they literally hire neuroscientists, they hire computer programmers, they hire psychiatrists or psychologists. Sorry, not psychiatrists. They should, but they don't. They know exactly where your breaking points are. They know exactly what patterns and what behaviors in the price action will trigger people and their impulses specifically to hit the button. Because when we get stressed out, our impulse control suffers, right? I'm sure everybody who's been around kids or on a hot day, you get an over-aggressive spouse, you just want to resolve things really fast and get out from underneath that stress. It's just if your clothing is too tight, you can't focus. If your mouth is dry, or you hadn't slept, or you're sick, you got a headache, you're not going to be as focused as you are when you're in the A game. You're focused, you're in the zone. If you got a bunch of metal touching your skin, for example, it's going to be differences in temperature. It's going to be distracting. Your brain wants to resolve that, and the best way we know how, thanks to evolution, is through violence, right? We want to take action. We want to just do something to get it out of our face, right? So in this case of the stock market, it's buying and selling, right? We push buttons that are there, right? They're literally right in front of us all day long. We have hotkeys to make it even faster. And as Tagman says, that's like walking around with a loaded gun. There's no safety on that. It's a Glock. You're just squeezing that trigger, man. So our brain, again, doesn't necessarily think of the aftermath or have a plan when it's time to do that. All we know is that we're resolving the stress. We're getting gratification. It's not going to be a problem here in a minute when it is. So we kind of have to just reprogram how we execute those impulses, and that's all part of the process. So one of the best ways we can do that is to address what actually causes it, and that again is stress, right? Any kind of stress, whether it's good stress, bad stress, emotional stress, financial stress, physical stress, those are all the same in that ultimately they cause our impulse control to suffer. Okay, so if you're stressed out about losses and you're not if you're not sure how to process a loss or a big red number, you're going to hesitate, or you're going to you're going to think a whole bunch of thoughts that don't really fit what's actually happening, right? We always think things are worse than they actually are. Sorry, I'm talking weird here. I just got a denture, and it's kind of weird to talk with it in my mouth. But our brains kind of reframe things in the moment differently than they do after the fact. And human memory is notoriously unreliable, but our emotions are not, right? But we don't want those to drive, because if that makes our decisions, we're going to suffer. I know I'm going off on a little bit of a tangent here, but if the majority of your impulses are derived from stress and trying to resolve that stress, the best thing you can do is reduce that stress. Okay? So if you're worried about, taking huge losses, don't take huge positions, right? It's common sense. It makes sense not to expose a whole bunch if you don't want to lose a whole bunch. If you're worried about, trading on too short a time frame and you feel like you have to rush and you can't really justify the trade setup, or you can't fill your orders in time, you don't have to look at low time frames. Right? So you have to give yourself permission to be comfortable when it comes to the stock market at the expense of what you might miss out on, right? And you can't cash that in at a bank. You can't bring potential profits to a bank and say, okay, I want to pay my bills. I want to collect interest on this now, right? What you can do is you can take the things that you can actually achieve relatively easily and without as much stress, and you can just work those in, right? So if your losses are a problem, you can take comfort in knowing that you get those back at the end of the year at tax time. And if you control the limit of losses that you're taking throughout the year, you know exactly how much you're going to get back at the end of the year on your taxes, right? Same thing with the profits. If you know how much your profits are, you know exactly what your tax burden is going to be. You can make estimated quarterly payments. You can offset things. You can do all kinds of stuff to ease the impact of that. You can tax loss harvest at the end of the year to offset it. There's all kinds of strategies that you can use so that you don't have that hanging over your head. Because I kind of used the phrase goldfish brain earlier today. When we're trying to take a trade, we should be like a fresh clone of ourselves, right? With no history, no memory of the last trade really, other than did we do it well? And what we can do for each trade is just kind of have that reset moment where we're like, okay, I'm ready for the next trade, right? I'm emotionally centered. I know exactly what the setup is. I got the entry criteria. I got my position picked out. I know my max loss. I don't have to feel anything, right? And then you're just following rules. That's the goal. You just follow the rules. You got a net result. It's going to be one of two results, okay? And then you take that result, and it's either a profit, in which case you got to pay taxes on, or it's a loss, in which case you get it back at the end of the year in the form of a deduction. Okay? There's no stress yet. Okay? You haven't actually done anything. You're just planning. Okay? And like Austin always says, worry is worship of the problem, and you can't get a refund on worry. Right? You pay it, it sucks. It's just extra stress. So what we can do with this kind of concept, right, is we can understand that those little tricks help us offset the stress. But that's just a concept. So we really got to dig into some specifics at that point and then figure out, what do I do to actually implement that? Okay? So really quick, I just want to take a quick inventory here. Does everybody understand what we've talked about so far? Because I am rambling so much and so fast.
Yeah.
All clear. I have to step away for a few minutes. I got to go help Tabby with Cole.
Son of a bitch. All right.
I know. I'll be back.
All right. He's trying to get out. All right.
No, not at all.
Later, DGen. Okay. Just kidding. Go ahead. what you got to do, man. All right. So for you guys, does it make sense so far?
Yep.
Yeah,
Okay. Perfect.
I'm liking it so far.
Good. That's all I need to hear. I just want to make sure like the concepts make sense, because then what we're going to do is we're going to take that and put in some specifics, and hopefully those specifics make sense. Snowflake, it makes sense to you? So I gotta keep an eye on this chat because it's going so far. I see Fergie and Snowflake just going at it, and I can't. I don't want to get too far off track because I know myself. I'll just start talking to them. There's a delay, and I'll have to wait like 30 seconds to answer a question. So I gotta be an adult here for myself. All right. So this is all for different stuff, special dividends. All right. Perfect. So what we're going to do is we're going to work in kind of off of this thing, right? Does all this make sense so far? About like just putting the bulk of it in reasonable things and then less of it in higher risk things, and then everything just balances out nicely? Okay.
So one thing, Cookies,
Yeah.
are we the tickers that we are talking about for the dividends and for the speculation? Are they going to be based off of the alerts that come out on the PB, or is it going to be totally different?
That's 100% up to you. So the idea
Okay.
here is that you guys should walk away from this mentorship and the series of one-on-ones, right? Because we don't just want to have this one masterclass. I want to have you guys set up so that we can give you a ticker, and then you can go and do your process, right? You gotta put that fuel into your own machine, and then determine whether or not it's right for you and how you want to trade it. Okay, that's the goal. Because then, if you can do that, I know I've succeeded, and you guys are set for life. I can get hit by a bus. I can finally just jump in front of that bus. No, I'm just kidding. But you guys won't need to rely on anyone. Sorry. I don't want you guys to have to rely on anybody else. Okay. Now that doesn't at all diminish the value of having a subscription like PB or using an indicator, for example, because those are big convenience factors. They save time, they provide resources, they optimize. Okay, so it's very good to have like the coaches, for example. You can get a brand new coach and teach you their strategy and stuff. But I don't want you guys to have to rely on someone just to survive, right? So this is just the foundation. This should absolutely always be free, and that's why we're here. So, and then, so we're gonna look at the dividend stock stuff first, and or passive growth, right? Or no, I'm sorry. Let's look at the speculation stuff first, because Patrick's not here, and I'm just kidding. All right. So just kind of leaning into the technical analysis stuff a little bit. I do have to change the screen share again. Give me just 1 second here. For some reason, it keeps putting your face on there twice. Sorry about that. I'm not doing it on purpose. All right, can you guys see my Webull?
Yeah.
Yes.
Okay. So in this case, this is a $1,000 portfolio, and so this this is a little bit of an oddity. It's a position. I'm just waiting for them to pay me. It's a stock that did a special type of split, and they're just going to give me a 90% profit, but they just have to, the broker has to actually do it at some point. So we can ignore this for all intents and purposes here. So we kind of talked about just the general up and down of the market, right? We talked about like kind of just visualizing a trend without really having to dig in. Like I'm not looking at individual candles here. I'm just seeing that the price is kind of going up, right? Super straightforward. I can see that this is a massive sell-off, right? I don't need to be a master analyst for this. It's just a big block of red, right? Same here. This is a big block of positive movement. So bunch of buying pressure, bunch of ask fills specifically drove that mid price up. That's an impulse. And then here's a correction. Here's another impulse, another bigger impulse. Here's some consolidation. Here's another impulse or displacement. Here's a range. So I don't want to get too fast with that stuff, but I just wanted to show you guys that there's like multiple ways to look at the market and stuff, but you don't have to learn it all and you don't have to apply it all, right? So there's a trend line book, retested, blah, 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 blah. Got a hard rejection late in the day. Does that kind of make sense? Like we're just looking for shapes and patterns and colors, and what you choose ultimately doesn't matter because I'm going to give you guys the secret here. And that is that your loss will always be the same size. So it literally doesn't matter, right? You can get it wrong as much as you want. Like take that pressure off yourself, because if you're trying to trade this, for example, and the price goes all the way down here, you're not down here trying to figure out what to do, right? The decision was already made and you're already out like up here. Does that make sense?
Yeah.
So nothing else matters. Like once you're out of the trade, it literally doesn't mean anything. You just know that you have a tax advantage at the end of the year and a realized loss. So if you have feelings about that, if you have thoughts about that are different from when you profit, that's worth writing down, because that's the journey of self-discovery that we all need to go through, and we need to figure out why we feel differently about that. Because I'm going to take it back a little bit here, and I'm going to talk about decoherence for a second. And I apologize so much to the Regs to Riches team because they have to hear me all day. But if you're familiar with the quantum physics concept of decoherence, it's basically like Schrodinger's cat, but a little bit different, okay? If you will, think of a magic jar. Okay, and this is the best way I can think to explain it. If you have a magic jar and you have a coin, right? This coin goes in the jar. Once the lid is on, it can be a heads or tails, right? It isn't either one, and it's also both at the same time. Technically, it's both, but blah, blah, blah. This is called superposition. Okay, it's two states at the same time until the jar is opened. Okay, and once the jar is open, the air comes in, and that solidifies it as a head or a tail. Okay, that's the concept of decoherence, is the actual realization of something, of one of two end results, right? And I'm trying to make that as simple as I possibly can. So if your trading plan is your magic jar, right, and you're putting a coin in that's always the same size, right, always the same risk size, and you're always pulling out one of two end results, there's no stress, there's no decision making, there's no guesswork, it's all done ahead of time. You built your jar, you already know how it works, you know exactly which coins you're putting in, you know exactly what potential coins you're pulling out, and as long as that jar stays intact, you'll always get one of two coins that come out of it, right? If you're pulling like old boots out, if you're pulling fish hooks, license plates, like something's wrong with that jar. Does that make sense? All right. And if you, since you built the jar, you kind of get a little bit of an advantage there. And we can say that, when it's heads, instead of pulling out one coin, we can pull out two. Does that make sense? And that's where that disproportionate take profit comes in, because every time we risk an amount, if we take twice that amount as a profit, we win twice as much as we lose every time we win. And that allows us to effectively take two coins out of that jar. Patrick is so lost right now. That's great. I'll catch you up. We're just talking about quantum physics. It's fine. But that's the idea that you want, right? There's certain parameters about every trading plan that I think should kind of always be the same, and that is they should address position sizing, they should address position purpose, they should address buy sizing, risk sizing. Like you should always have a max loss tolerance, and there's a couple different ways we can apply that. That's pretty cool, so we'll get into that in a minute. And then the actual strategy, right? You got to have a strategy. It's got to kind of make sense. It doesn't have to be perfect. Again, nobody's going to be right 100% of the time. But when you're wrong, how you're wrong matters. And that's the big secret. Like every successful trader on the planet knows that. Every non-successful trader knows what they should do, but it's too late most of the time. So that's something we can fix, right? We can identify that. So when it comes time to, sorry, I flipped my windows around too much here. When it comes time to actually look at a chart, all your other decisions should already be made. You should already know what your position sizing should be, how many dollars you're going to put in each buy, where your stop loss kind of should be at a maximum, unless you want to use, again, those other strategies, which are pretty cool. Like why you're trading it in the first place, making sure it makes sense for that position. Like if you're looking at a day trade on SPY, for example, and you've already used up all your day trade funds, and you find yourself selling your investment shares just so you can day trade SPY, you're punching a hole in the side of your jar. Air's going to get in there, and you're going to start pulling out weird stuff. Right? You're throwing your coins away at that point. So we can fix that by just making sure that that jar stays intact and it's well defined. Right? So everybody here can make a checklist. Everybody here can pick and choose their own little pieces, and I'll show you guys a very simple strategy that I love to use, and I know the Rags to Riches team loves it. It's very, very simple, but it might take some time for you to actually put it into place. All right? And one of the easiest and best ways I can think of to do this, and I just found out from, I think, Matzer, that Mark Douglas actually recommended it that way too. He's deceased at this point, but he's one of the best trading psychology guys out there. So if you ever get a chance, watch his videos. but it's to look at trades in sets of, you know, some number, right? I just choose 10 because it's a nice round number. I think he used like 12 or something. Top uses 20. He's one of our most successful traders in the Discord. Love the guy to death. He's got amazing self-discipline. But if you can just look at 10 trades, start to finish, right? And you've got a checklist, and you can go down that checklist for every single trade and say, I didn't do that. I didn't do that part. I didn't do that part. I did that part. And just go through every single one of those trades 10 times. You will have enough data for your next 10 set of trades, right? Or next set of 10 trades, grammar, right? And then once you can get all 10 trades consistently done, 100% success rate, regardless of profit or loss, you should be like 1,000 trades in, right? That's typically how it works, like a couple hundred at least. But once you've done all 10 consecutively and you get a 100% success rate, and you can do 10 more with a 100% success rate, then you can shoot for 200. And at that point, you should have many, many figures in your bank account because, again, throughout all 200 plus, you know, several hundred trades, all your losses are going to be the same size or smaller. So within 200 trades, you're going to have a big runner at some point. I'm willing to put some money on that, right? So in theory, right, that makes sense, and you should be able to grow a portfolio pretty easily, just with some common sense stuff, right? That sound agreeable so far? Okay. So what do you do? Like, how do you actually make that happen? And this is where I'm going to just teach you guys one of these strategies really fast, and you guys can, you know, plug and play. We've got indicators you can use. I got free indicators. I got paid indicators. They're a little more efficient. But let's just use the moving average. And in this case, if you're on Webull, you go up here to the indicators, you hit MA, or you can click this drop down. It's right here under main chart. This stands for moving average, and much like the line chart, each plot on this line here just represents the average of the last 20 periods of closing price. So what that means is this green value right here. Can you guys see that? I hope so. What this means... Yep. All right, thank you. So if I look back 20 candles, I got to zoom out just a little bit here. Okay. If I look at the last 20 candles and just look at their closing prices, oops, Webull hates me. All right, so if I look at these candles right here in this range, okay, and I just add up their closing prices, all right, so I'm going to switch back to the line chart here. If I add up all these values and then I average them, I should get this number right here, 221.60. Does that make sense? All right, and then if I move the line this way, right, then I'm looking at these 20 candles or plot points, right? And then I'm looking at these 20. So every line on this is just an average of the closing prices within that period. All right, so you can change the number. It doesn't have to be 20. I just like 20, and I teach people 20 because it's a nice consistent number, and they don't know that. That doesn't matter, right? So sorry, Rags Reaches team, if you're watching, I don't really care. It can be the 5, it can be the 34. It doesn't matter, right? But 20 is nice and easy, nice and clean. And actually, one of the coolest things we can do is we can take this number and we can just look at the chart, and we can apply this up and down to see where it most closely matches the price action. So you can see this touches here, touches here, touches here. So I'd say 28 might look like a pretty good one. It rejects there, it kind of supports here. Just in this very limited 1 minute time frame view here, it looks like the 28 might work pretty well so far. Right, we get quite a few little bounces off it. It's well respected enough. Okay. Now we don't want to do this on the 1 minute time frame, so we're not going to do that. But I just want to show you guys that with a pretty clean chart there. And what we're going to do is we're just going to use this line, and we're going to put some common sense rules in place to make sure that the trend is going in our direction. We're going to ensure that we have a super tight risk, and we're going to trade a responsible position size when that happens. And when it doesn't happen, we're not going to trade. That makes sense? Because why would you trade when the trend's not going in your direction and all that good stuff? Other than trying to catch the bottom and all that good stuff, which doesn't really work for most people. So let's kick it up to the 5 minute time frame. All right, and yeah, that'll work. Why not? Okay, so one of the first criteria that I want to look for, and let's use a different stock because I kind of like this one. We're going to use the RR in the 15 minute. We'll come back and we'll try some other ones, but I just want to show you guys some use cases or some specific examples, right? Because this kind of has what I'm looking for. So this green line here, if you put your mouse anywhere over here and you look up here, you can see the value of it on Webull. So all we're looking for is to make sure it's positive. Okay, so from here to here, the slope is visually negative. We can see that. We don't really need to go candle to candle and see what the value is. But right here, it turns positive. It's 493 to 494. So in that case, and it just goes up from there. So what I can do is, once it turns positive there, I can just draw a vertical line, and I can just change that to green. Right, and that way I just know it's in a bullish state because the positive slope on the moving average is there. And then all I have to do is look for a specific pattern, right? And it's one of two cases. And the first one is very, very easy, right? Can you guys see these two candles right here?
Yeah.
Okay. You guys might already know about this, and sorry again, but it is what it is. So the opening price of the red candle here is going to be the entry threshold. Okay, and if it's above the moving average and there's a space right here, I'm going to want this candle to be as small as possible, right? And the reason for that is because since we're off the moving average, there is strength, but we don't want to take big risks by having a candle all the way like this right here. We don't want to take a huge risk all the way down to the moving average if we can get a little tiny one right here. Okay, so when the price forms, right, this is what we're going to see in real time. Okay, the price is going to push up. We're going to see that positive slope on the moving average. We're going to see a tiny red candle. And then we're going to see the price break over that. Okay, so as soon as the price breaks over that, what we can do is we can place a stop loss at the lower of these two candles. Okay, and we can look for an entry above this. And I'll walk through the actual order types and how to actually participate here, but we just want to get the theory down first. This is a very, very tight risk, and this is exactly what I love because it's my bread and butter. And there's a drawing tool that you can use on Webull specifically for this. Where you can set your entry and set your stop loss and all that, and then you can have this little ratio right here. So in this case, if we're using a 1 to 2 take profit, which means that for every cent we risk, we want to collect 2 cents worth of profit range. This is a 5 cent risk right here, and we've got a 10 cent profit range. So we would look to take profits right there if we wanted to. It's a 1.92% risk. And that's because we're on a small time frame and all that good stuff. But this one would have been a very successful trade because we're not just locking everything right here, but instead we're going to lock the majority of it, which I'll explain why in a second. And then letting the rest run until we see certain criteria, and then we just trade it mechanically. Does that make sense? Like, your risks don't ever have to be bigger than that if you don't want them to be. You can have 1% risk on everything, 2% risk on everything, 20 cents risk or smaller if you want to, and then you can look back over the course of a year and all your risks are 20 cents or smaller. You might not have had a whole bunch of trades, but the winners should definitely outweigh those 20-cent losses. Does that make sense? Okay. So what I like to do personally is when the price hits this first target, and let me just pull this up on Miro as well in the background here. I think I might already have this mapped out. Okay, I do. All right, so I'm gonna kind of have to just share the screen. Nah, we'll make it work. I'll use this. So when the price hits this first disproportionate take profit level, what I can do is lock 75% of my shares, right? Or some disproportionately heavy portion of what I have, right? And what that allows me to do is it locks in the bulk of the profit. So if, let me just draw this out over here, right? So if this is my risk and this is my profit, and I've got, this much of a position in there, and I entered right here, and I want to lock 75% of it right here when the price comes up. That takes this portion of it. It's hard to draw on here, sorry. It moves it up there. I'll just put this over here. Right? And then I've got a little tiny piece of it left. Okay, 25% is left. And then what happens there is if the price continues moving, oops. All right, if the price continues moving, God, I hate this. I can still move, I can still let that happen to this 25% that I have left, right? Now there's certain criteria for actually selling the rest of it. But I can catch these huge impulses on, smaller and smaller pieces of my position, because remember, the higher the risk, the smaller the position, or the smaller the risk exposure, right? And it all balances out, because I might only make, $10 here, right? But I can also make $10 on this little 25% piece, It's the same concept, right? It's the same. So I made $20 on this trade without taking insane risks to get there. Now, the major advantage here is that if the price sells back off, right, the price on the remaining 25% of the shares doesn't just have to get back to my break even or even to my stop loss. It's actually got to go 3 times farther down. So if I just draw this, for example, right, it's got to go 3 times farther down before I can give these profits back that I collected here and locked in. Does that make sense? But since the stop loss is in place, that'll never happen. Does that make sense? It's just built-in risk management. I don't have to think about anything. It's cool.
Right.
All right, just good old-fashioned position management. I haven't even looked at any candles yet, other than just the slope on the moving average and tiny little risk right here. Right, that's just one of a million different strategies you can use. But the concept of locking in the bulkier position at a disproportionate take profit and then letting the remainder respect the stop loss guarantees you a net profit on that trade. Okay. Now, the drawback, of course, is if you take a bunch of trades at 100% loss, right, at the stop loss, it may or may not outperform this, which is, if it was a 1-to-1, but that's why we have a 1-to-2 take profit. That way it's guaranteed to be disproportionate, so you should win. And then, of course, you're going to have profits like this, It gets pretty stupid pretty quick, but that's the idea. Okay, so then we're going to look for this other pattern, okay? Do you guys feel pretty good about this one? Mostly just because it really takes your risk down a lot.
Yeah, it's simple.
It's
Just
stupid.
setting those parameters.
Yep. Now, a lot of people are going to see stuff like this and be like, oh, I could trade this and blah, blah, blah. And, you certainly could, right? But then look at how big your risk is. Well, in this case, it'd be down here because this candle closed earlier and then pushed up. Why would you take this size risk when you can just wait a little bit more and grab something like this? Right? I'll trade these all day long, and I'll take losses on them all day long because all it takes is one profit and they're all gone. So if you look at this, you don't have to take these big red candles and risk them. And then we can, and I'm going to teach you guys how. That's where the 1% rule and stuff comes in. But for the sake of just getting started and being consistently safe, right? Why not trade stuff like this? Right? And first thing, remember the first step is just to make sure we have a positive slope on the moving average, which in this case we do, right? So there's your entry, and your stop loss is actually on this white candle here, and then a disproportionate take profit, right, for that initial 75%. So that always happens first, and then I look for other things to actually sell the rest of the shares, which I'll talk about here in a minute. But is that clean enough? It's super simple just to get consistent base hits over and over and over again?
Absolutely.
And does it work on only the 15-minute candle or 15-minute time frame, or is it consistent amongst
I'm glad you
every other
asked.
time?
So happy you asked that. It works on any time frame. Now, with that said, it is a machine and depends entirely on the fuel that you're putting in. So if you're on the 1-minute time frame and something is just garbage and there's gaps all over the place, it's low liquidity, you're not going to get good results. So you got to trade high quality stuff on an appropriate time frame. But the strategy itself is stupidly effective because it's taking those risks and bringing them way down super tiny, and then your profits will just outperform them.
So what is the ideal time frame to look at these?
Well, that's going to depend on the stock because every single stock has a different float, the different numbers of shares available, and they're also going to have different levels of volume or attention from day to day. I'm just using this one because I looked at it earlier today and it's got the specifics that I wanted to teach you guys, and then I'll let you guys give me tickers and we'll just walk through it to show, the P&L on it, right? And that's the cool part is I can teach you this and then you can go replicate the same results somewhere else. It's an empirical approach, right? So if we were to enter on this one, right, I'm just going to walk you guys through a couple examples, right? Does this seem like a reasonably small risk? 1.5%? I think we like that. I was off by a little bit, right? We lock 75% here. It guarantees a net profit, and then the rest can go all the way down here and hit the stop loss. We're still net profitable. But the plus side here is that the upside is unlimited, right? So it's just a matter of when you take the profit. So we need to address that, right? We need a strategy to kind of make that mechanical so we're not just guessing and hoping we pick the right spot, Now, if you're trading like this and you see a big candle like this and you're a new trader, there's absolutely nothing wrong with just taking that profit and running, right? Because you can see the next candle here is a big red candle, and that probably would have messed you up psychologically. It's just, it's red, it's scary. I don't want to watch my profits disappear. That's a fear, okay? That's an emotion. We can identify it and eliminate it with specifics. So if we're looking for specific workarounds for taking profits, what we can do is we can look for two patterns, right? And I'm just trying to make this very simple for you guys so that you can plug and play the strategy. Ultimately, all strategies are the same. It really doesn't matter. I don't care what anyone says. But let's look for some specifics, right? So I'm just going to move this up here. And this is the 5 candle rule that the Rags to Riches team all knows and loves. And that is just any series of 5 more candles that has higher lows from candle to candle. So some of these may have wicks, some of them might not. Does that seem like it's something you can identify pretty easily?
Yep.
Yeah? All right.
Yeah.
It's pretty straightforward, right? You could draw a line underneath any candle, and then if the next candle is below it, it's not 5 candles, right? So you just got to get 5 of those in a row, and you can literally just follow a line. You can follow it up with a line. As soon as that 5th candle closes, that's where your partial stop loss goes if you're following this strategy, okay? And that is just going to be another 75% of whatever you have left, okay? So if you have $100 shares, when that 1 to 2 take profit hits, you would have sold 75% of those shares, or 75 shares. You'd have 25 left. Does that make sense? And then you see this guy come along, this 5 candle rule, and price goes up. Let's say we get another higher low, another one just for funsies, and we get one way up here, and then we get a sell-off, right? Or some sort of pullback. We invalidate the low of this candle. So we would just follow these up. Every time this candle closes, we wait, we move the stop loss up, right? Until we get to right here, and then we sell 75% of the shares we currently have, which is 25 in that case, right? So you'd sell like 18, 19 shares. And then you would just wait for the next pattern to form. Does that make sense? Super clean, super easy. All right. And the next pattern here is pretty easy as well, and that's just a higher validated low. All right, also a 5 candle pattern, so pretty clean, pretty easy. All right, the magic number is 5. All right, I can erase that. And what this is this is going to be... Oh, you popular son of a bitch. So this is just another pattern that we can look for, and it's super easy to identify. You know, these might not all be in this perfect V shape. Like this one might be down here. They might not all be sequentially low like that. What we're looking for is this candle right here, right? It's got to be isolated as far as where the low is. So this low is what we're looking for, okay? And all we want to do is make sure that 2 candles to the left and 2 candles to the right minimum are higher than the low of this candle. Does that make sense? Okay, so we just don't want anything to come down and challenge that low or break into a new low. And what this is this is a low that's validated, okay? And in this case, we know that the price has come down. Remember, this tells a story. So we know that the price has come down, tested the level, and then it's pushed back up. So if it comes back down here or below there, we don't want to be in that trade if we want the stock to go up, right? It just doesn't make sense. So we could just sell it if it invalidates that low. So at this point, when we see this candle close, the second one on the right, and we validate this guy, okay? That's a higher validated low. We can move our entire stop loss up. Does that make sense? Because again, it doesn't make sense to be in that trade if we want it to go up, if we break into a new low, all right? So,
and this does not include the wicks, the up and down wicks,
no,
right?
Yep, it does. Yep.
Oh, it does. Okay.
Yeah, we're looking for the lowest possible point that the price went during that period of time, and that's where we put that level.
Oh, okay.
Yep.
Okay.
Now this one, for example, like this might have a wick that comes to, oops, I just drew that. Let's say that this is a little bit wider. Let's say this one came down to like here. It's a little hard to draw this unless I expand this over. Like, let's say that wick happens. That's okay. That still counts because it still doesn't invalidate this low. Does that make sense? Perfect. All right. So what we're going to do is we're going to look at that chart, that same entry. Okay. And I did kind of cherry pick this one based on what I liked. But I'm going to show you guys the different scenarios here. All right, so this was our entry. Okay, we got just a quick break over this this red candle body. We got a positive slope on the moving average. We got a nice tiny risk, so we took an entry here. Stop loss goes below the lower of these 2 candles. Make sense so far? Okay. and then we get a push up. We get our disproportionate take profit right here, so we lock in 75% of the shares immediately. That way we're guaranteed net profit. We can move our stop loss up if we want to, but we're not gonna. But we've locked in some sort of net profit already. Okay? And then what we get here is we get 1 candle, 2 candles, 3 candles, 4 candles, 5 candles with higher lows. Can you guys see that? Okay, so we can lock in, when that's invalidated, we can lock in 75% of our shares that they're left holding, right? And we still have some left if we have more than 2 shares, right? So at this point, we've got a 5 candle run, and now we've pulled back. So as soon as we start invalidating that low, I don't know where that went. I might have deleted it. As soon as we start breaking lows on the candles, then we can start to look for that other pattern where we move our stop loss up. So in this case, we've got this candle, okay, which already has 2 candles to the left that are higher. And then let's see what the low is here, 607, 607. So it would be this one that we're looking for. So then we get 2 candles to the right, and as soon as this one closes, this guy is validated. Does that make sense? Okay, it's isolated. There's nothing else that really breaks below it. So this is our stop loss. So our 100% stop loss would then just move up to this guy. Okay? And then let's see what we get. We get, this is the first candle. 2, 3, 4, 5, 6, 7 candles in a row that have a higher low. And then we invalidate that. So we sell 75% of what's left. Does that make sense? All we're doing is we're wearing down our position with certain patterns until we run out of shares. Okay? And the 5 candle rule specifically just captures impulses. It's just saying price keeps pushing, it's not coming back lower, it's just up, up, up until it turns around, and then we don't want to be in it as heavy, right? We want to lock a piece of it, but we want to kind of stay in it because there's still that strength. But when it's a higher validated low, we don't want to be in it when that gets invalidated. So what we can do here is, you see this guy right here? You see the 2 candles to the left, 2 candles to the right that are higher? That's our new stop loss. We move our stop loss up. And then we see what we get. So this guy here doesn't count, right? Because the 2 candles to the left here, this one's lower. So this isn't an isolated low. What we get is we get a higher low, then we get a lower low. So we got to start the count over on this one. So 1, 2, 3, and then we got to start over. 1, 2, 3, and then we get lower, right? So we got to start over. But what we have here is a higher validated low. So it's not something that I have to guess. It's just clean mechanical action, and it's making the decisions for me, right? The chart is telling me when to buy and sell. All right. So in this case, 1, 2, 3, reset. Okay. And then we don't get a higher validated low here because of this guy. 1, 2, 3. Nope. Doesn't count. Let's see what this one is. So right here, okay, this candle, we get a higher validated low because 2 candles to the left, 2 candles to the right. They don't breach that line. They don't touch it. So this is a higher validated low. 1, 2, 3, 4, 5. All right, 6. Oh, price is getting away from me here. So let me just draw a little horizontal line here so we can use that for our fella, right? So this is the first candle right here. Second candle, third candle. Touches it, doesn't breach it. Fourth candle, fifth candle. All right, 6th candle, 7th candle, 8th candle, 9th candle. 10th candle, 11th candle, and then we breach it. Does that make sense? All right, so we're just locking in impulses, right? And what's cool about this is you start to look like a badass because a lot of times you're going to get these little tiny candles at the top, and you're going to look like you picked the absolute top, when in reality you just caught the end of an impulse as it was turning around. So in this case, we get another impulse, so we lock in 75% of what's left if we have anything, and then we get a higher validated low right here. So this becomes our new stop loss, and depending on how much you put in your portfolio, that's another impulse right there. You can do multiple iterations of these in a lot of cases. This is a higher validated low. Boom, boom, boom. Let's see here. We get another impulse. Like, I'm not guessing here. It's just the stuff just keeps happening, And that's the beauty of an uptrend, is that you've got multiple opportunities to lock those profits, and multiple entry opportunities as well. So if I were to erase all these lines, okay, and I just picked it at this random time, okay, you got a kind of a sizable risk here, so maybe we pass on that one. We got that's no entry right there. Maybe you get an entry right here, right? Entry into stop loss, because at one point this was a bullish candle. It was up here, right? And that's the important part about backtesting, is you have to be honest. So, maybe this was an entry that went up. It just happened to go up. Maybe the next one goes down and you take a loss, right? That's the whole point of this, is it doesn't really matter. You don't have to be right all the time. Bless you.
Thank you.
Here's a risk. This one also happened to win. Sometimes they just sell off really drastically. Here's another profit. Then you get stuff like this that's close to the moving average, and this is where the magic happens. So if I just draw this guy, that guy, that's a potentially, I don't know what that is, 21, 21 times prop 22, so 1 to 22.5. Now you wouldn't have caught all that, but you could have, right? You were in front of it. You got another opportunity right here. You got another opportunity right here. Another opportunity right here. You've got one kind of here if you wanted to. You're starting to get the bigger candles here, and but if it fits your risk tolerance, you can trade it. This is a perfect one, and this one just happened to stop out, right? So this one would have been a loss. You would have had maybe 3 winners, maybe 2 losses, maybe 3 and 3. Doesn't really matter at the end of the day, right? Because your losses are all the same size. So that's a pretty easy strategy. And if you're on, let's say you're on the daily time frame, okay, maybe you just want to trade swings and you want to just kind of, you got to have that positive slope on the moving average first. That's always a prerequisite. Maybe you grab this one, okay, maybe this day closed, right? You were right here. You say, okay, I got a tiny red candle. I got a positive slope. I want to trade this one. So I'm going to set an order for right here for the next day. And this will be my stop loss unless we get like a lower low and then it pushes up, which you'll have to recalculate a little bit. But if you want to just catch an entry off of this guy the following day, maybe you had that.
Oh, Pookie's real quick. How did you pick that specific one? What was that? Is that because it was going up, or it was the smallest one, right?
This one
you
here?
Picked this one? No, yeah. Is that the one you picked, or
this one right here? Yep. So I picked this one only because it's got a small body, small risk. Right. So this one, if we wanted to, you could consider this risk here, but that's much, much bigger and it's far away from the moving average. So you can always pass on that one. Right.
Okay. But then the smallest one is also, it looks like equivalently far away from the moving average, but the risk is low.
Absolutely.
And that is the reason why you're picking that up. Okay.
Yep. That's it. That's the only reason.
Okay.
That's it. Now, if it was on the moving average like this guy, I allow a little bit more risk tolerance, and this has a positive slope and all that. But that's only because it has that moving average, so it increases the probability of success because it's got that average push. Whereas up here, you don't really have that same support within the volume and within the supply and demand, so I kind of have to keep it tight. So pretty much anytime I see a super small red candle, I'll take it if it's got a positive slope. But I'm also locking in those profits much, much sooner.
And how do you say that it's a positive slope?
Is
it because?
Yep, just right here. So if you look right here on the screen, if I move my mouse...
the moving average is going up. That's the reason why. Okay, I see.
Yep.
I see. Okay.
That's it.
Okay.
And then if you didn't lock your profits here, for example, if you didn't lock them in tight on this, the price might have just skyrocketed. We have no way of knowing that. But what we do see on this one, price went up, we could have locked our profits, but it also would have stopped out relatively soon after that, which is why we want to guarantee that net profit and set that stop loss nice and tight. So that's really why I just have those super tight risks above the moving average like that. Like this trade I would have never taken. That's way too big. Like this, so that's way too much risk, and then the profit has to be up here somewhere, which in this case it happened to work, but why put yourself through that,
Right.
It's not worth it. But there is a way we can work around that. Oh, Patrick left. He had to go do his thing. Sorry, I have the actual cameras and stuff on another screen. Sorry. So like this one here, we could have still looked at it, right? It's an 18.5, 19% loss or risk range, right? But then that also means we have a 38% profit potential, which is right around here, right? So it's still doable, but we have to make a slight change, okay? So I promise I'll teach you guys about like the actual order types and how to actually get filled and stuff, but I want to teach you guys the concepts first. So if we have a situation where the risk...
real quick, Pookies. So you marked the profit range, right, Mac, or the 75% sell range. That how does that come into play? Because it doesn't meet any of the wicks on the upper side or on the lower side. Is it just an arbitrary number that I pick up and I put it
Are you talking about
for
the?
yeah, that line? Yeah.
Yeah.
No,
So
no, the.
let me just draw the tool here so you can see it.
Mm-hmm.
So if this is where we're putting our entry right above this open,
Mm-hmm.
and this is where we're putting our risk range or our stop loss, that's our risk
Stop
range
loss,
right here,
yeah.
this red area. So
Mhm,
it's an 18.62% risk or $1.27, right?
Mm-hmm.
And if we just bring this ratio up 1 to 2, or close, right? We can see that that's kind of where the target ends up. It's just twice the risk range.
Okay.
Yep.
So we are just basing it off of 1 to 2 risk ratio. If my loss is $1.27, then my profit would be close to $3 or $4 is where I'm marking it arbitrarily.
Yep, just twice that. Yep.
Okay.
Now you can always look at like the higher time frames and see if there's something like a resistance level getting in the way or some other criteria, which you'll get more exposure and more education and stuff to kind of filter out some of those riskier take profits. But just for the sake of putting a coin in the jar and getting one of those two end results and collecting data about yourself, which is really where you got to start, and about how you handle those trades, this doesn't really matter, right? Now, nobody wants to put $100 or you don't want to put 10% of your portfolio in and take a 18.5% loss, right? Because that's very counterproductive to stable growth, right? So what we can do instead is we can use that risk range and we can work a little bit of a formula, and then we can make sure that that loss is the exact same size loss dollar-wise as every other trade we take. Right? So this is where we get a little bit magical, okay? So we're going to apply something called the 1% rule. So if you took a $10 share and you lost 10% of it, you would lose $1. Okay, you'd have $9 left. Pretty straightforward, right? But if you took that same $10 and put it into another stock and took a 6% loss, you would have $9.40 left because you'd lose 60 cents. Does that make sense? So $10 position equivalent doesn't always get the same end result, so your wins could underperform your losses if you don't do certain things, okay? And that's kind of, I think that's one of the unspoken things that kind of messes up new traders that do find consistency, because they can find consistently winning trades and still struggle to get positive, right? So if we apply something called the 1% rule, we can work around that. So what the 1% rule is basically figuring out how much of your money that would equal 1%. So in this case, I'm on a $1,000 portfolio, so $10 would be my max loss ever if I use the 1% rule, okay? So if I just add a little text tool here, $10 max loss is 1%. 1% equals, okay? Hopefully you guys can see that. I can put my notepad on the screen if that's easier for you. So this is my 1% rule or $10 max loss. So what I need to do is I need to look at this risk range, okay? And in this case, it's $1.25 or $1.26, right? And then I just need to figure out how many times that goes into $10. That's how complicated it is, right? So let me open my calculator here. So 10 divided by 126 is 7.93 or 8 shares, right? 8 shares. That's all I got to do. Now, I need to take that number, that 8 number, and I need to multiply it by $6.81 to see if I can afford those 8 shares without exceeding my budget. Okay? What did I say? 681. 681 times 8. Let me just open up my calculator again. Sorry, my machine's being a little weird. 6 times 681 is $54.48. Okay, so it's $54.48. So if I'm allocating up to 10% of my portfolio for this position, right, up to $100, and I know I need to buy 8 shares to risk 1% of my portfolio, I know that this fits my budget. So $54.48. So even though this is an 18.5% risk, I know I can take this happily and still not lose more than $10. Does that make sense?
Okay, so we are not taking $100 as a fixed value for every trade. It also depends on, so it's basically the percentage that we are taking, so that we could limit the loss to the same level.
Same dollar amount. Yep. Now,
same dollar amount.
Now there's a little bit of a catch here, and this is kind of where it becomes a little bit more magical, right? So if you work through the math, okay, if I'm taking a 5-cent risk, it's going to tell me I need some astronomical number of shares to equal $10, right? Well, it should be like 200 shares or something, right? Because
Right,
nickel
right.
goes into $10. Now, 200 shares is not affordable at $6.81 or whatever. If we're risking up to $100, okay? So we can't use that for super tight risk ranges. But what we can do in that case is we can just apply the $10 or the $100. I'm sorry, right? Because we know it's going to be
I see.
that size or smaller. So after a certain point, we want to start applying the 1% rule. So we need to figure out what our magic number is, and that's just a little bit of math, right? And that's going to depend on your portfolio and the stuff you're trading and things like that. But anything that is super tight risk, just as a general rule of thumb, day trades that are super tight, super small moving averages with the tiny engulf candles, those are going to be just flat positions that are a percentage or some fixed amount, right? And that's all predetermined. You don't have to do any crazy math with that. If you want to trade the bigger stuff, the bigger risks that are outside your risk tolerance, like I would never risk 18.5% on a 10% position because that would lead to a bigger loss than I'm comfortable with. So then I would apply the 1% rule to make sure that I'm still only ever risking 1% of my portfolio, which is $10. So $100 losing 10% equals that same amount. Does that make sense?
Yep.
Magic, right? We unlock all those other trades that we couldn't normally take without increasing their loss potential. And since we have a disproportionate take profit, guess what our profit is every single time? 2%.
Minimum to the 7. Yeah.
2% of our portfolio, or the amount we're using to trade. Okay?
Right.
So once we kind of identify those two different approaches to position sizing, this all becomes a lot more comfortable, right? Because then we can also we don't want to do that today, but we can extrapolate that out to options, and it gets really complicated if we want it to be. But
So options also is that the same, but the prices on the options do fluctuate very on a higher range, right?
yes, so the let's actually talk about what options are really quick, because I think that'll kind of be a little more valuable. So for those who don't know, options are basically just a contract. Think of it like let's say that you want to reserve a spot in a park for 5 days. Okay, you'd have to go to your town. You'd have to say, hey, I want a permit for the park for this many days, and I'm going to pay you this much money. Okay, you pay, you get the permit in exchange, and then whether or not you want to use the space in that park is entirely up to you. And that's essentially what an options contract is. You're just buying or selling the right to buy or sell shares. Okay, whether or not you use it, whether or not the other person uses it, it's just reserved, and you pay a fee for that. The seller of the contract then collects that fee, and that's another way to make money, is selling contracts. But for now, we'll just consider it in the context of a buyer. Okay, so I want to buy the right to buy 100 shares, so I would buy a call, and I'd pay a fee. And then if the price is moving like crazy, and there's a lot of time left on the contract, and there's all these other factors come into alignment, I can make a lot of money on that contract just by selling it back, right? Because I bought it at a low price, it inflated insanely high, and then I could sell it. Now the risk with contracts is there's always multiple outcomes, right? The one that I think most traders are familiar with is when it goes to zero. So you lose your entire investment. So we want to catch it before then, right? And that's also where, again, we can apply something like the 1% rule to identify exactly where that percentage should cut off. Like I did earlier today, I traded a Tesla. The contract went down about 30%. My max loss was still only 15% because I was only halfway in, because I was measuring where I placed my ads. So again, it's the same end result, as all my losses are the same size, right? Now, when it comes to actually exercising that contract, if I wanted to actually buy those shares, I have the right to. I paid for it. I would then have to pay for those shares at that price, right? So it gets a little bit. There's a little bit of an obligation that comes with them if you decide to use them. There's definitely a lot of obligation if you sell them. So for most traders and for you guys, when you enable options, that's usually the beginning of the end, right? Most traders mess themselves up far worse at option time than ever before. And again, it's not the end of the trades that means you've messed up. It's usually earlier on, you just didn't realize it. So we can avoid those. I hate the fact that most traders start trading options with naked contracts, because it's the highest risk possible for the lowest overall reward. And just people don't know what they don't know, and that's okay. Options by design are intended to be hedges. They're used to offset and acquire shares rather than just trading the premium and the speculation up and down, right? But that's, most people start backwards because they want that money. Okay, Nikki, thank you. I'm glad you were able to hang out. This is all recorded. I won't be going on too much longer because I want to have some one-on-ones with these guys later on. But for this one, I just kind of want to get some general info out there so people don't hurt themselves. Yeah, so for options, you can use those to hedge. If you're expecting a lot of volatility in the market, you can figure out roughly how much your portfolio will be affected by specifically determining something called a beta, a portfolio beta, and then you can buy contracts to offset that value, that potential volatility range, and that's called beta hedging. That's one of the most mechanical systems out there. Hedge fund managers use it all the time. It's a very publicized strategy, but nobody does it, right? Nobody on the retail side. You can also rotate the wheel, which is just a way of using sell orders to acquire and offload shares, and it's just passive income. There's not really much real risk. There is still risk though, so you got to understand it all. There's spreads, which are just ways to offset the obligations of contracts and offset the price as well. So people in smaller accounts can trade spreads pretty easily. There's just raw covered calls, cash secured puts, all the other complicated stuff where you're just you already covered the cost of the stuff, but you're just getting paid to kind of buy and sell them or just have them, right? And that's kind of our goal, is just to do as little as possible and still make money, right? So on the option side, it's going to be cash secured puts, covered calls, selling spreads, calendar presses, all the other stuff, right? Not just naked contracts. And then on the equity side, it's going to be things like dividends and growth stocks, and it's the slower moving stuff you don't have to manage. If you want to add in the more volatile speculation, if you want to add in the buy here, sell here, kind of look at the chart all day, you can use the 1% rule to take bigger risks. You can use the 20 MA and the engulfs. You don't have to do any of that stuff if you don't want to, because remember, at the end of the day, this is a glorified savings account. So you control the interest rate, but you also control the fees and the penalties. So you got to just kind of be mindful of what you're willing to risk and what you're willing to lose. And, again, just obeying that hierarchy. If you're not able to speculate successfully on a practice account, is it really worth risking real money and potentially setting yourself back? Or is that money better spent in a savings account or collecting 5% interest from your broker? If you want to gear in, because there's an emotional obstacle when you start trading real money. So if you want to start scaling in, you can start using small amounts. You don't have to use your full portfolio and hoping you make it big, right? Because that doesn't happen. You're not going to be the first person in the market to ever figure it out. I guarantee it. It's just not very productive in most cases. So for the sake of kind of leaving here with something specific that you can use rather than just a concept, do you guys have a specific ticker in mind? Or just throw a random one at me, or chat can too.
Let's do Unity.
Unity? All right, I like it. Let's do it. You got a time frame? Give me a time frame.
Oh God. You know what? Let's do 15 minutes.
15 minutes. All right. So I didn't force your card. I let you pick something, right? Right. Completely unprovoked. I didn't coerce you or in any way. What I'm going to do.
I think I see a 5.
You see that? You see that?
Yep.
You see that?
That one. Yep.
You see the relation between all these? You see this guy down here?
Mm-hmm.
What happens if we look at the lows of all these in relation to each other? They're higher, right?
Mm-hmm.
Yeah.
All right. And that's it, right? So if the moving average has a positive slope and you're seeing higher highs and higher lows in the price action, you're going to get multiple opportunities here. All you have to do is just not trade the garbage in between, like this, right? This is not meaningful to me. I can't trade it. There's nothing valuable here. It's a higher risk and it's off the moving average, so I can pass on that. Okay, but maybe.
But the one that right next to what you selected, the smallest one. The other one, the next one, the next one. No, on the right side. 2 more on the right. Yeah, that guy.
Small one.
This guy.
Yeah,
okay.
that guy.
Uh-huh.
So is that something that we could bank on?
Well, so if we look at it, right, if we're looking for the color change, so from red to bullish, right, this candle doesn't break over that threshold that we need. So there's no entry on this one.
Okay.
This
No
one
entry
does.
on this one.
Yeah. And
So,
if
okay.
Yep. So in this case, we would have made a nice profit, but we would have had to use the 1% rule. Because for this trade specifically, because remember, this was bullish at some point, right? Because it's got a wick. That's the risk range right there. That's the profit range right there. So we would have to look and see, okay, this is 23 cents. How many shares at 16.61 do I need to buy so that if I lose that 23 cents, that I only lose 1% of my amount? Does that make sense? Because 23 cents might not seem like much, and we're on the 15-minute time frame, but it's still, that's a big wick compared to all the other guys, right? And that's really what it's about. It's just looking comparatively. And that's it. That's all we have to do. So in this case, it would have happened to have won. It would have been a profit, and you would have gotten 2% of your portfolio as a profit, right? Now, if we look at, let me just erase all these other guys. So if we look at this guy, right? Because it's up there, but it's not super far off the moving average, but it's a super tiny red candle, okay? There's your stop loss, and then we would have had our disproportionate profit. That would have been a loss. Does it matter? If it's super tiny and those are the only ones I'm taking if they're off the moving average? I don't think so. What about this guy? Does that really matter? If that would have lost? In this case, it happened to go up really, really high, but would that have mattered at the end of the day? We got this guy right here. Let me just draw this because I want to show you guys some not just winners. And this is kind of where I think a lot of people tend to respect the process a little bit more is when you show them the losers too. Because I'm all about, being consistent. So in this case, you would have entered right here on this guy. Does that make sense? And actually your loss would have been probably there because we don't know if we don't know in hindsight if that would have gone up before or after. So that would have been the risk range right there. So in this case, it's 7 cents. So since this is a tiny candle and a tiny risk range, I'm okay taking that with just a regular 10% position because it's a super tiny risk. It's within, acceptable range where it's not going to affect me if it, goes. But 7 cents, into this many shares, I can't use the 1% rule for that. But it's within my risk range, so I don't need to. This guy right here. Okay, we've got an entry. Oops. All right, we got a stop loss. We've got an entry here as well. Okay, and we got a stop loss on this guy. So these are roughly similar, but we've got a negative slope in the moving average, so we don't have to trade any of those. Right? Criteria number 1 on the checklist, we need a positive slope. So why would I even be looking at that, right? I don't even have to think about how many dollars I'd put in. I don't have to think about where my target's going to be. None of that. I just have to look at my checklist and say, is that green line moving up or down?
Yeah. Right. How about the 5 candles down, the small red candle out there, which is below the moving average, but it's still on the positive slope.
This one here?
Right. Yeah.
So you could, right? And this is kind of where, at the end of the day, the strategies don't really matter, but this comes at a personal cost, right? So yes, the probability is low, right? Because you are still trading an engulfing candle, so there's still potential, right? You're trading a color change. The probability here is still lower because it's below the moving average. And this happens to have worked out, which is confirmation bias, right? We're seeing an end result that we want to see. But if you statistically tried this, let's just look historically here, right? It would have worked here. It didn't work here. It didn't work here. It didn't work here, right? Or maybe it did.
Right.
Yeah, it did. Okay. It didn't work here, though, if you traded that color change. It didn't work here. It did work here. You get inconsistent results. And like here, for example, too, if we look at this guy right here, this color change on this pop, that's a loss, right? Doesn't really matter too much because our risks are all the same size, but it's an unnecessary risk. It's an unhealthy risk because we can't justify it, right? We can't say, oh, the price is above average, more people are participating in the bullish direction than usual, right? Than average. And we also have this nice tight support level below us, which is the moving average. It's a dynamic supply and demand line. And that's it. So right here, for
So,
example.
real one last question.
Yeah.
So here we are only looking at the historical data, right? Say if I'm looking today, if I'm looking into one of the ticker, right, and if I want to map uh, my trades for tomorrow or day after,
Mhm.
whenever the opportunity presents, right?
Yeah.
What should I be looking at? Like this is how I have now in this case, since the moving average is down, so I'm not even going to look at it. I'll probably move over to a next ticker of some sort, right?
Absolutely.
But then, if an opportunity presents there for me, and I am looking at a ticker that has the smallest risk level,
Yeah.
at the end and the last candle, I'm looking at the last candle,
Okay.
and I'm seeing that the last candle is above the moving average, and the moving average is going up.
hmm
How I cannot be really sure that if the moving average will continue to go up, right? Because if you look at the 5 candles before the last candle, you see that the moving average is going up, but suddenly it starts taking a turn to the to south and
hmm
starts going down, right?
Yep.
Now, what will give me a surety that the moving average is going to go up?
You don't have one. There's no way to
Okay, so
guarantee that. Yep. Now it
that's
does.
going to be a gamble.
Yep. Well, it does take some time for moving average to turn around because of the nature of
Uh-huh.
averages, right? So it should continue going up
Mhm.
until enough compelling force pushes it to the downside. But in this
Mhm.
case, like if we look at this chart specifically, we got a massive jump up here in 2 candles.
Uh,
So 2 of these values are up, and then the rest of these are
right.
deflating. So this is a good
Uh-huh.
chunk of why this turns around right here. And then we spend some time
Okay.
below the actual moving average, so that's going to pull that down even harder. And that's what kind of where you get this little slope right here is when those start kicking in.
Right. So the
Um,
cause is 5-10 candles before, but the effect starts showing up 5-10 candles later.
right, right.
Okay.
And yeah, and then, like I said, like you can use like just to cut through the BS here. You can use any strategy. I don't really care. Like if you just want to trade, let's say let's add the 5-8-13 moving average, right? That's a popular one. People
Uh-huh.
love that. I like it. If you just trade when the moving averages are positively stacked like this, and use a similar concept when it comes to how you manage your risk, you'll have the same end results in as long as it manages risk effectively, right? So if this is your entry right here, let's say this right here, this guy right here is the first candle, okay? That's your entry. Your stop loss would be probably right below the moving average, so we can use that. What does this tell us? It tells us we need to use the 1% rule because that's a bigger range, right? It also tells us
Right.
that our default take profit should be somewhere twice that range, and we can also use these moving averages as dynamic stop losses. So if you just want to use this big red stop loss, this 34 EMA, you would take your profits right here. So still a successful
Right.
trade, right? If
Mm-hmm.
you want to use the super trend indicator, right? Easy. We can do it all day long. For that one, you're just kind of grabbing. Let me just erase all these lines. I have 4. I'm so spoiled. So if you just want to grab that there, and this is your initial stop loss, you got to use the 1% rule, and there's your take profit. You got that. Is every trade going to be a winner? Absolutely not. Is every loss going to be the same size? Absolutely.
Yes. Yes.
That's it. So the only reason I prefer the moving average strategy is just because it's a little easier to explain visually. It really doesn't matter. You can use parabolic SAR, you can use super trend, you can use even the indicators I made, like Stocks Buddy, Beacon. Beacon has it built in. That's what the little yellow lines are. And that's it. And that allows you to actually set a max risk threshold. So if I don't want to risk any more than 20 cents, I can just hit the little checkbox, and that's it.
Can you really quick show that on the trade view? Because this morning I was looking at it in Beacon, and I was trying to figure out what that really means. The yellow bar that you talked about.
Okay. Yeah, let me change over the screen share for you guys just so you can see it. Window, trading view. Okay. All right. Are you able to see this?
Yes. Yes.
All right. So if I add Beacon, I have to accept the little disclaimer here. I unchecked that. So this number right here, this is the max risk tolerance. So if I'm looking at a stock and I don't want to risk more than 20 cents, I can set that to 20 cents. It's going to vary by stock. You can plug the ATR value in here as a little cheat. And then just check that box and it'll filter out everything that doesn't fit. I'm going to leave it unchecked though. So for this, right, if I just look at like this, sorry, right here, like this entry right here, right? It's the same concept, except this kind of doesn't include the whole wick there. It just includes a portion of it because it uses this candle. But, you know, that would have been the entry right there. So when the price breaks over this yellow line, that's your entry. And your stop loss goes here. So in real time, that would have been a stop out. And then you got this entry here because it kicks out over this red candle. And this is the low of these 3 participating candles. So this would be the trade range, the risk range. So let me go ahead and draw that. So you would have entered here on this green candle as soon as it broke over this red candle. That would have been where you place your stop loss because it's the lowest of these 3 candles. And then your 1 to 2 take profit would be right there, roughly. So you would have taken a profit on that one. And then if I erase that, or I'll move it over, right? Because there's another entry right here. And then here's the risk range. And then here's the disproportionate 1 to 2 take profit. Make sense?
Yep.
And then, we got one more right here, and then I'll stop shoving examples in your face. But it's got everything kind of factored in already for you. All you have to do is figure out where you want to take that profit.
Right. And it really doesn't matter if it is a day trade or a swing trade, as far as you have your values mapped down. It could very well be a day trade as well, right?
Absolutely.
Depending on how the stock moves. Okay.
Yeah, this is on the 15 minute. If we kick it down to the 1 minute, you can see it just filters out stuff that is counter trend. And it leaves in the stuff that is in the direction you want it to go. Now, you're not going to catch the absolute bottom. You can see there's a lot of this that gets left out. But
right.
what's in there is high quality in most cases. Right? Now, the lower you go, the less reliable the price action becomes. But you can see here it still works, right? And as always, it's important to look back, right? Because you don't just want to look at the confirmation bias there. So,
and here the yellow line is the level where if it breaks the yellow line, then that's our entry, and the red is the stop loss according to. Okay.
That's it. So like this right here, that's a winner. This is a winner. That's a winner. That's a winner. Blah blah. This one right here is a loss. Just so you can see, this one here is also a loss. Okay, so you would have entered on the break, and then your stop loss would be right here. You would have stopped out. Same here. You would have entered here on this guy. You would have stopped out on this one.
Right.
But they don't matter. They're small, right? And then you get a win like this. You get a win like that. A win like that. It gets
So
pretty
you don't win them all.
Right, and you don't have to, and that takes so much pressure off because you don't have to be right all the time to be successful. So one thing I do want to do really quick is I want to go to the Discord channel, and then I want to pull up that screener that I had. Let me just grab that for you guys real quick, and we'll just
strat.
No, just looking at the FinViz screener. So FinViz is a stock searching site.
Screener. Okay.
Yep.
Okay. Yep.
Yeah. So I'm gonna change the screen share a little bit, if I can. Let me erase that. Sorry. I got it pulled up here. I got too many windows open. So, all right. So let's try that. There we go. Okay. So let me change the screen share for you guys. And I'll just put it over here. Ooh, sorry guys, I know it's taking a minute here. I got so many windows open. All right, can you guys see that?
Yeah.
Okay.
Yep.
So what we're looking at here is a screener, and there's so many settings on this because I enabled them all, and this is just a pre-made screener that I made for you guys. But I want to show you guys some examples here. So I'm just going to look on the daily chart, and or the daily time frame. I'm sorry, and we're just going to look at some examples really, really quickly. So AAP, I can already tell this has a positive-ish slope. Actually, yeah, let's just do that. I'll keep this in another tab. You guys can see that that's the criteria there. What I'll do is I'll switch this back over to Webull so you guys can kind of see how the charts look. But that screener is specifically pinned in the Rags to Riches team chat in the Discord, so you guys can access it.
Okay.
All right, so if we look at AAP right here on the daily time frame, this is Advanced Auto Parts, you can see that we have a tiny risk right here. All right, so tomorrow what we could consider doing, and I'm not saying you have to, but if you really like this one, you could plot out all these levels, and if the price breaks over this guy, right there, then you could look for an entry, and this would be your risk, and you already know whether or not you need to use the 1% rule based on this risk size. It's 0.94%. So, you're looking at a 2% profit. So not the biggest initial profit, but then again, you're only locking, oh, damn, did I draw that 1.8 to the dot? Almost. But that's kind of the rough trade setup that you'd want to look for tomorrow, right? Now you want to take
So,
oh, go ahead.
the when you say the price breaks that point, right? It could be. Does it have to close with, say, if we are looking at 15-minute time frame, or is it whatever time frame we are looking at?
Yep.
Should the price be above that point at the end of that 15th minute, like the other candle that shows up above that, or is it like as soon as it crosses it, we should be able to make an entry?
Yeah. So as soon as it crosses, that's when I look for them.
Okay.
Because what you're doing is you're trading the direction change, the change of ownership for the trend. And in this case, this is kind of where the bears, the sellers, had kind of their last stronghold, right? As soon as the buyers can conquer that, the bulls, we have justification at that point that the trade should continue in the upward direction.
And you look at the days, or you look at the daily and then move over, or are you just doing it?
Well, so in this case, this screener uses the daily time frame to chart or to filter stuff out. So I'm just using that because it's demonstration.
Yeah.
But yeah, you can always optimize it within there, and you can actually get quite a few trades within the same chart. In a lot of cases, if you get a good strong trend, you can just like this, you can just trade the hell out of it, right? So tomorrow, like if I wasn't able to look at the market, right, what I could do is I could set. Let me just erase these boxes here, right? We got our key levels. What I could do is I could say, okay, tomorrow the market's going to open somewhere up here, or maybe it is in extended hours, right? So it's doing this little weird float thing. You can't trust any of this price data. So tomorrow morning when the price opens, or 9:30 when the market opens, what I could do is I could change this to a buy stop order, and that's just one specific order type that doesn't become active until the price breaks above it. And then it just converts.
Is that only in Webull, or Robinhood also allows you to do that?
Yeah, I think you can do that on a lot of brokers. It's basically the stop loss for short sellers. So it's a specific order type. I believe Robinhood has it. I just hate Robinhood and I don't use it that much anymore. They did.
Yeah, they're not that. They're user friendly, but not friendly enough.
Yep. Or what you can do if you're on Robinhood and you hate yourself is you can set an alarm for this price, and then once the price breaks above it, you could say, okay, I'm just going to place a buy order, right? And as part of that, you can also set up a bracket so that when you place the order and when it gets filled, it automatically sets a take profit and a stop loss at these specific levels. And all the price has to do is go up at that point. Now, the only catch to that is if the price goes down at market open and it doesn't go up and you form a new low, you'll have to move this level down and recalculate the number of shares you buy for the 1% rule. But that's a simple math problem at that point. And you're not going to hit this alarm unless that happens anyway. So if you're doing the manual order route, it's easy. And what you could do also is you could just set an order for this level and say, okay, if this breaks, then I know I need to go in and watch this one, recalculate stuff, or cancel my buy order and all that good stuff. So you can always pass on the trade too. Yeah, that's it. And that's just a matter of kind of using the tools that are available. So if I look at, I'm just going to go through these really quickly. ALEX. So this one here doesn't have an entry. It's got a positive slope.
Because it's below.
Yep. There's just
below the moving average.
Yeah, and there's also not a tiny red candle here. There's nothing we can justify.
Right.
So we don't need to add that to a watch list. AMWD. This one is beautiful. It's got a kind of a flat one, but we got a gap here just for people that love those. We got a tiny little red risk here. So we got a nice tight defined risk range. We can watch that one. So we can right click on it. We can say add to watch list, and we can say watch list. Right? That's a different watch list on that account, but you get the idea, right? We can make a note of it. That screener bumped out like 56 stocks, right? This one here is a beautiful one, right? Beautiful potential entry here. We would have ideally looked to enter today because we had a positive slope. The price moved up, it broke over, and that would have been our risk range right there. Makes sense? ANAB, same thing. We don't have a entry today, but we might have an entry tomorrow on the break of that.
Tomorrow, yep.
And we know that that's kind of a wide risk range. Now let's look here, and we're breaking our plan already because this has a negative slope.
Yeah.
right? So we know we can pass on this. We don't have to even look at it.
Mhm.
It's deleted. We're delisting it. It's taken off the stock market. Sorry, everyone that bought some, you're losing your money. This one here has an equal slope, which means it can be considered positive or negative. So I'd probably look for a trade here, but I might look at a different time frame. But look at how small that risk is.
Mm-hmm.
Now, in this case, we've got a gap to the downside, and there might be a lot of bearish pressure. We got kind of an inverted. We got a head and shoulders forming. So for the more experienced traders, maybe we pass on that one. But the whole point of the beginning part of your journey is figuring out not just how to make profits, but how you consistently or inconsistently follow your trading plan, right? So your job is just to execute, ideally on a paper account, just 10 trades, right? Just any 10 trades, any strategy, as long as it's the same strategy, start to finish, see if you can get that 100% success rate regardless of profit. And then, look at that data and say, oh, wow, I really need to work on this, right? Because this is messing me up. Because then that's going to translate into the next 10 trades. And you can look at that. Oh, that's a nice one. I like that. But you guys get the idea, right? You're looking for ways to diagnose yourself. And you have to do that by looking at the symptoms. And you can't just think of what your system should be, right? Or what you think your symptoms, sorry. I like that one too. Like this one, beautiful, beautiful setup. Now it's got a little bit of a wider risk range, right? So we know we can use the 1% rule. Take profits somewhere up there. Easy peasy. And same, right? We got a gap here to the downside. We got a head and shoulder setup. So this has massive potential to come down here.
Not a bad, yeah.
But I don't care because I know that my max loss is only ever going to be 1%.
1%.
Yep.
Right.
Now, if the price comes down here and I'm still in it, that's something I need to write down because then I've deviated from my plan and I'm paying for it.
But then why would you enter into this when you know that there is a head and shoulders and it's a bearish movement? Is that because you don't know what market is going to do tomorrow? It could even turn out to be a bull as well.
Yeah, nobody on this planet knows. That's the cool part. So head and shoulders often break as well. I know we're kind of conditioned to believe that they always fill out, just like gaps. Like gaps don't always fill. That's such a lie. That's such a load of BS. So head and shoulders could just as easily break to the upside. All we have to do is be in it. And if we don't like it, we can always pass on it. But again, if we're just paper trading and we're just collecting those 10 trades, just getting that data, there's really no reason not to try that trade, in my opinion. Now, I don't recommend just taking a loan out and doing all that crazy stuff.
Right.
But you can at least practice it, and you can chart it out. You can add it to a watch list. You can get in the habit of saying, okay, I'm new to the market. Here's a list of tickers that have this specific setup. I'm going to add them all to a dedicated watch list. I'm going to plot out the entry level. I'm going to plot out the stop level. I'm going to plot out the target level. I know exactly what my position size will be tomorrow. If it hits, if it doesn't hit, no trade. If it goes down, no trade. I know whether or not I need to apply the 1% rule or can just use a flat position on it. I know exactly how many shares I'll be selling at take profit and then what to look for after that. Like, it's a whole process. And then all the while, you want to make sure you're documenting, am I tired today? Am I pissed off at my spouse? Are my kids up my butt? Are they screaming in my ears? Like, my dog need to go out. There's all kinds of factors that can distract us. Am I sick?
Right.
Did I not sleep well? Am I dehydrated? So there's all kinds of different things that we need to pay attention to. And if, your environment is a factor, that needs to be kind of identified and you need to work around it. Right? Because ignoring it doesn't make it go away, So,
right.
But that might tell you that maybe you're not good for day trading. Maybe day trading just is too risky for you because of that, right? It doesn't mean you're not a good day trader. It just means you can't focus.
Right.
So I do have to end this here. I wanted to shoot for 2.5 hours, and it looks like we're just 2 minutes shy of that. But really quick, I just want to ask you guys, do you have any questions right now? Because we're going to get into like the dividend stuff. We're going to get into the fundamental stuff, like how to actually look for quality stocks. The order types, account types, and all that stuff, like cash versus margin and all that good stuff. We'll get into all that stuff. I want to have a series of one-on-one episodes with each of you guys. Is that something you're down?
Yep. Oh, yeah.
Beautiful.
Totally.
All right, I'm going to get Patrick, too, when he can't get out of it. All right. So do you guys each, do either of you have a questions or a couple questions specifically before I cut this off? Because I don't want you guys to walk away thinking that you're hurt.
I don't. My answer is pretty much my question was pretty much answered. But if I've been writing stuff down, so if I follow up, it'll be one-on-one.
Good. All right. Perfect. And
I also might shoot you a message after this.
okay, I'll check it when I can. This is also recorded, so you guys can watch this as many times you want. I know there's a lot of information here. My eyes glazed over a couple times. I get it. But you can always watch it back.
Is it going to be posted on the R2R channel, Pookies?
Yeah, this is all right on my YouTube channel. I'll put a link in the Rags to Riches channel as well.
Oh,
I'll put
okay.
a link in my notes.
Yeah, but I am also making an active point not to promote it or not to advertise it specifically in PB because I don't want to pull people away from what they're already focused on. This is more of a aggressive beginner's approach, I guess.
I love it.
Okay.
Yeah,
so it's pretty good. So if you can just post it on on the new group that you created from where you posted the meet channel, I think that would be good enough too.
Yeah,
right?
yeah, I could put you in there. Or do you just want to be in the Rags to Riches team itself? I mean, I can do that.
Yeah,
Okay.
yeah. That's not a problem. Yep.
Perfect. Or I think you are, right? I think you already are.
I'm already in there. Is it pinned down? Okay, YouTube channel. I see that. Okay, yeah.
Yep.
I think that's pretty good. Pretty enough.
Yeah, we'll get to taken care of. And then, yeah, like I said, so I'd like to have at least one episode per week with each of you guys on your own time, obviously. We'll have to figure out the scheduling and stuff. But Zach, I'd love to just sit down with you for like a half hour once a week or maybe an hour or so.
Perfect.
All right, just like this. Yep. And then same for you. And then also Patrick. So that'll give us 3 episodes a week, basically, one for each of you. And then you guys are also welcome to watch each other's episodes if you want. If you got time.
It's actually not a bad idea. I didn't think about that.
Yeah, you get 3 times the information, right?
Yep.
All right, cool. So I'm basically I wanna give you guys a proper amount of focus, and I know again a lot of this information was rushed through. Like we didn't talk about a lot, and that's okay. But I do have to jump off of here, unfortunately. But I want to just make sure you guys are solid, and through these next episodes, they're just going to be one-on-one. It's just going to be you and I talking back and forth. And we'll just kind of dig into the specifics of like, notice we didn't buy anything today, right? We're not looking at stocks. We're not looking to buy stuff right away. I want to teach you guys kind of how to look at companies, how to look at the market as a whole. And we're going to shift some of that focus away from the charting and more into like actually growing the portfolio with investments and dividend stuff and protecting ourselves against our default bad habits. All right.
That's good. Yep.
All right. So thank you guys for hanging out. I appreciate it. And I will end the recording here as well. Let me just thank you all.
Thank you for
watching
doing
this.
this, Cookies.